Third session for the St. Kilian's Church VITA. And today we're going to run through some of the various credits, and then toward the latter part of our session, we're going to go through I'd call it a comprehensive return. It's the Gene Arista exercise. Okay, so here we go. This might look familiar if you've ever been to Washington, D.C. This is the headquarters of the Internal Revenue Service. I've been there, I think, once. Never been in the building, though. All right, so our objectives. We are going to talk about reverse mortgages. That was one of the questions that popped up last time we spoke. So we'll give you some basics there. And then we're going to talk about information returns. And you will hear me say again and again and again, there are information returns that are issued to taxpayers. And a lot of times those information returns have a taxable income that needs to be reported. And an information return, an example would be a W-2, a 1099-T if you're a college student and you're attending university. So those are examples of information return. And then what you're going to do at the VITA site, you're going to ask taxpayers for information returns in addition to that intake and interview form they're going to be completing. And again, so these are examples, some examples of information returns. If you asked an IRS employee how many information returns exist in the IRS system, they will tell you many, many, many information returns. There's literally, I don't know if there's thousands, but there's hundreds and hundreds of them. And so today we're going to focus on the 1099 MISC, NEC, and then some of the new rules for the 1099K. And you'll see that 1099K again and again at the VITA site, and we'll discuss that in detail. And then some of the credits, and you may have heard me say before, there are non-refundable credits, and those are a dollar for dollar reduction of the tax. And then there are refundable credits. And that means even though you don't owe any tax, you can still get money back if you're eligible for one of the refundable credits, such as the earned income tax credit. And then we'll talk about the child tax credit. We'll talk about the additional child tax credit, the other credit for dependents. We'll talk about the child and dependent care credit. And that's generally when you drop off your minor child at some type of a daycare facility. So you can either go to work, or you can look for work, or in some cases, there's what is called a plug figure if you're attending some type of higher education. And then we'll talk about the earned income tax credit. That's one of the, I think that's probably the biggest credit that you can get. And that is a refundable credit. Both the federal government and the state of California have an earned income tax credit. And you might remember if you attended some of the training, the federal government and the state government have two completely different tax systems. And so sometimes you'll be eligible for something on the federal side of the house, and you're not going to get it on the state side of the house, or there are just different rules. For example, for the earned income tax credit, different rules for both federal and state. And then we'll talk about the education credits. We see a lot of this at the VITA site. And when you hear the term American Opportunity Tax Credit, that is a credit that has both a refundable and a non-refundable component. And we'll talk about some of the rules for college students who are attending school and whether or not they're eligible for that credit. And then the lifetime learning credit, you see a lot of that. And we'll get into the rules there. That's typically when you have someone who might have already graduated from college, or they're attending part-time, less than one half. And then there's some other topics that we'll talk about to include unreported tips. We'll talk about step up in basis, a few other topics that we have bumped into over the years. And then we'll talk about the practice lab. If you receive the Gene Arista 2022 tax return, you should be aware there's one correction that needs to be made on the fact pattern, and that correction is everything is 2022. And so if you're looking at it, or if you're going to look at it, the daughter for Gene lived with Gene 12 months in 2022. All right, so those are the objectives. And then the administration, we're not going to go past 1 o'clock. We might even knock off a little bit early, depending on how fast we get through our material. And then about every hour, we'll take a break so you can recharge your coffee and clear your head. Okay, well, I always like to go through what are called selected IRS and FTB references, and that includes not only the what we call the code section, but also different types of authority and also various types of publications and instructions. I have found over the years the 4012 is an excellent publication, but sometimes you got to dig a little bit deeper. And you typically would go to the IRS website. You're able to download forms, publications, and documents. And again, there are many, many different forms, documents, and publications that you can refer to. And the same thing with California. California is a little bit less friendlier downloading materials. Sometimes if you want the PDF document, you actually have to request it. I've done that many times before. California, what they'll do is they'll email it to you. And so typically you can get that document, but it does take a little bit more of a step. All right, so I'd like to start off with Section 61 of the Internal Revenue Code. You maybe have heard me talk about this before, but this is important. This is what I do at my VITA site. We have to follow the publication 4012. But what happens a lot of times, taxpayers will come to the VITA site and they have, we ask them about income, and they're not sure whether or not it's taxable or not taxable, or it may be taxable in part. And so what I tell my volunteers is put on your tax hat, and that tax hat includes Section 61, which basically defines gross income. And so what that means is everything is included in gross income unless otherwise excluded. And so if you go to your 4012, you're going to find a lot of different exclusions. Like, for example, if you receive a bona fide gift, that is an exclusion. If you receive an inheritance, and let's say that inheritance happens to be cash, that would be an exclusion. But again, there are many, many different exclusions. Most of them are listed in the publication 17 or the publication 4012. Or you might have another document, such as the publication 525, that talks about the various exclusions. All right, and then I was asked by Sean, our site coordinator, to talk about Notice 2023-74. And what this notice talked about is the delay in the implementation of the rules for the 1099-K. And so we know the 1099-K is an information return. We see a lot of that. I've seen it for individuals who drive for Uber and Lyft. I've seen it for, I'll probably get one myself because this past season in my tax practice, I received a lot of Zelle payments. So I'll probably get a 1099-K. But the bottom line is it's an information return. The rules are changing, and those rules for tax year 2023, the current calendar year that we're in, for tax year 2023, the rules will be, the implementation would be the entity has to have paid a taxpayer $5,000 or more in order for a 1099-K to be issued. Now, when we're talking about the next tax year, which is tax year 2024, what that means is if you've received $600 or more from certain entities and you're eligible for a 1099-K, you're going to receive a 1099-K. And again, when you do have a taxpayer that comes in with an information return, sure, you're going to take a look at it, you're going to ask some questions, and sometimes an information return does not have taxable income on it. And so that's why you have to do a little bit of probing, if you will. And then our next item, our next reference, there's a what is called a IRS Service Center Advice. It's a little over 20 years old. And so when you're talking about the earned income tax credit, we know for federal purposes that you have to meet a number of rules and you have to have earned income. And so typically our VITA clients, they've got W-2 income or they have self-employment income of some kind, but there's different types. And the publication 4012 does a pretty good job differentiating between earned income and income that is not considered earned income. And so we do have people who go on jury duty. And when you look at the software, it asks you, if once you select jury duty pay, if that's considered earned income. The answer is no, it's not. And even though that's not listed in the publication 4012, this service center advice, it's been out there for a while. And so now you know that jury duty service pay is not earned income. And then, of course, we talked many times about the 4012. We're going to reference a couple pages in the 4012 this morning, and so kind of reinforce some of our knowledge. And if you're new or newer to VITA, that 4012, again, it's the go-to document. I typically have a hard copy, and if I remember correctly, Sean, I think you had some hard copies delivered, and so we're able to give them to the volunteers who work at the VITA site. At least that's my understanding. So
Yeah.
you want to have the hard, I say again, Sean?
Yeah, all the St. Killian volunteers, we've had the books for a month now.
There you go. And so again, a go-to document for you. You'll be referencing other documents. And what I do at my site, I typically have a hard copy for myself because I need to spill coffee on it. I need to write notes in it. And you're going to get certain things where you may want to update the 4012 pen and pencil changes, if you will. We will talk about the 6744 this morning. There's a volunteer tax alert. And when you hear that term, what happens is the guys and gals at the VITA program, the IRS, they put these things together and they do a pretty good job. However, they're not perfect. No one is. And so what happens is there's volunteer tax alerts that come out, and that would be for the written material that the IRS has put out, or in some cases, the software. And if you've been with the VITA program for a number of years, the software that we're going to use, the live software coming up in about a month and a half, it's pretty good, but it's not perfect. And so sometimes there will be errors, and that means the guys and gals who have to program or reprogram that, they do that, and then there's a notice that comes out, and it trickles down to the individual volunteer to be aware of that, or they simply say that it's been fixed. Publication 17, if you haven't spent a lot of time with that, again, another go-to document. And if you want a hard copy of that, my understanding is you have to purchase it from the IRS. It used to be given out at taxpayer service centers. Now it's all an electronic document. But again, no harm, no foul. I use the 17 again and again. I simply load it on my computer when it does come out for tax year 2023, and then again, use it as a go-to document. We will show you today, Gene Arista will show you the Form 1040 once we complete it, and then the various schedules. We've already talked about the Form 1040 instructions, and I've mentioned before that sometimes taxpayers say, how do you calculate the individual income tax? And I say, well, it's in the software, and they go, okay, well, is the software correct? And what we do, we'll show them the instructions, we'll show them the tax table. The tax tables themselves, for our purposes, we're looking at filing status and we're looking at taxable income, and then the corresponding individual income tax associated with that taxable income. We talked about the standards, volunteer standards of conduct, and again, that's embedded, if you will, in the Lincoln Learn program, along with the Pub 5101 for intake and interview. And if you haven't spent any time looking at the intake and interview sheet for a while, it does change every tax year. And so for tax year 2023, it has changed slightly.
Gary, I put something in the chat about the errors in the 6744 that have been released. So I put that in the chat. So make sure you look at those and change your booklet before you take any of the tests that are affected. And then I guess I've got a request to have them emailed. Sean, I don't know if I know you've already emailed it, I think once.
Yeah, well, I just emailed it to the individual who was asking for it.
Okay, got it.
Yeah, that was John, right?
Yeah.
Yeah, that's a good point. We'll go over those today, but when you do see a volunteer tax alert that's modifying or changing some type of document that the IRS has put out, then it behooves you to go to that document, make your pen and ink changes. But we'll go through those changes very quickly here. Okay, so the volunteer standards of conduct, this is your contract, as I've mentioned before, between you and your site coordinator and the IRS. And so what that means is you simply want to prepare, or I should say certify in the Lincoln Learn program. And then what happens is your 13615 will be auto-populated with your contact information and with the level of certification. And if I remember correctly, Sean, if you have someone at the St. Killian's VITA site that certifies at the basic level, you'll still put them to work at the site, right?
Yes, we will.
Okay. And then I highly recommend, and I recognize everybody has certain limitations, but if you can certify at the advanced level, I highly recommend it. That way you're ready to go. You can conduct reviews. If you work at my site at Coastline College, everybody is certified at the basic, at the advanced, and at the military level. But again, that's my recommendation. Certify.
Oh, I was going to say, I was going to one correction. I think at the St. Killian site, correct me if I'm wrong, Sean, even if you're not certified at the basic level, you can still volunteer at the site. There's many things that you can do in addition to just preparing taxes, and we need
Right.
people.
We'll do, if anybody who's at least volunteer standards of conduct certified, we will find a job for them.
There you go. Maybe running out for coffee or making coffee or something like that.
Just greeting people, smiling. You can have lots of smiling people.
Very important thing. Yeah.
Yeah, and that's a good point because some people are not going to certify at basic or the advanced level. So like the gentleman say, you have an opportunity to volunteer in some capacity. All right, then we talked about 334. That publication is revised every year, and we're talking about for Schedule C folks. This is another go-to document. It talks about record keeping. It talks about income. It talks about expenses. It talks about credits. And I know at my site, I'm not sure about St. Killian's, but at my site in Garden Grove, I think about 10% of our taxpayers have Schedule Cs. A lot of them have side hustles, so they have a W-2 job they work at, and then they have a small business, maybe walking dogs or driving as a courier or something like that. But again, another great document that's helpful. In my tax practice, where I charge people, what I do is I make that recommendation to my clients who have Schedule Cs to review, maybe not study in detail, but review the 334, and it'll jog their memory. Another document that you'll probably end up reviewing from time to time during the season is Pub 503. And this talks about the child and dependent care expenses. And again, typically when you're going to work and you've got a minor child, obviously you're not going to leave them at home unattended. That minor child is going to be dropped off at some type of daycare facility, or perhaps maybe a private residence where someone is licensed by the state of California to watch kids. And that's where you get that child dependent care expense credit. Dependent, that would be someone, maybe they're not a child, but maybe they have some type of mental or physical disability, and you can still, and you're in charge of caring for them, you can still get some type of non-refundable credit. One of my favorite pubs, 525, taxable and non-taxable income. You're going to have, and in the VITA program, we see it all the time. We have individuals that come in and they state, they make an exclamation that they've received some type of court award. And I think I get maybe, excuse me, I think I get maybe 2 or 3 letters a year talking about Jerry, you're part of some class action lawsuit, which I didn't know about it, and there's been a settlement, and here's your check for $3.14. And so it begs the question: is it taxable or non-taxable? And so 525 talks about those items, those court settlements, and I see this again and again in VITA. And so when people come up to me and say, "Hey, I got a court settlement," I usually say, "Okay, understood. How much is it? Who's it from? And what's the nature of the award?" Because a court settlement could be a taxable event. A court settlement could be a non-taxable event. or court settlement could be a partially taxable event. So you got to do a little digging, and sometimes that requires a telephone call to the entity, i.e., the law firm that settled it. Again, 525 does a great job. And then another pub that you may not have seen if you're new or newer to the VITA program, that's 554. And so when you're talking about senior citizens, typically that's defined as 65 and older. There are provisions that apply to them that do not apply to the rest of us. And you're saying, well, Jerry, why is that? Well, that's easy. Congress comes up with all sorts of provisions for Native Americans, for military personnel, for seniors, for disabled people. And so those are, for lack of a better term, a special population. And so seniors, the discussion, the 554 will keep you straight when you're working with the taxpayer, if you need to jump into the 554. The 596 talks about the federal earned income tax credit, also known as EIC. And that publication has example after example after example. But typically, again, your 4012 will be your go-to document, but sometimes you got to do a little digging. And then something you'll see about 10% of the time at VITA sites, more or less, is individuals who have some type of residence, a personal residence, and they have a loan with a mortgage company or the bank. And in a lot of cases, they're allowed to deduct their home mortgage interest, which means they're going to have itemized deductions on their Schedule A. The 936 has a lot of examples in there. And that's something I actually use the 936 in my practice when I have an involved home mortgage interest deduction. Another great publication is the publication 970, and these are tax benefits for education. It not only includes the lifetime learning credit and the American Opportunity Credit, but it also has other types of benefits for education. And 970 has lots of examples. And so if you don't find your answer in the publication 4012 and that particular fact pattern is in scope, then your 970 most likely will answer the question. We talked about continuing education credit. That would be for individuals who most likely on this call, we probably have some California Tax Education Council registered tax preparers, and you've got some enrolled agents. You might have some active CPAs or maybe even an attorney. And so if you want continuing education credits, you can get those. But what you have to do, you've got to make sure that you review that pub, and then your agreement, that 13615, you've got to show the IRS, show Sean, because Sean most likely will be the guy who's going to go ahead and verify your hours. You got to provide information. For example, I'm an enrolled agent. I have to share my practitioner tax identification number. And if I'm not mistaken, I think also my EA number. And so same thing with CPAs, they've got a number associated with their CPA. And of course, attorneys, they have the bar card. And CTEC members, they also have a number that's issued to them by CTEC. And then this volunteer tax alert, we're going to jump into this real quick. And so this is one of the, I think this is the first one that comes out. And typically during the season, you'll see maybe a couple, 3 or 4. And so what it is when they do come out, your site coordinator will be aware of them. And then that information will be shared with the preparers or anybody at the site. And I think at my site, usually we don't print it out, but we'll have a briefing. We'll talk about it. And that way everybody's aware of it. And you can also, it's not a state secret. You can go ahead and email it freely to your volunteers. And we'll talk about that right after I finish this slide. And then regarding the Franchise Tax Board, the state of California, mentioned last couple of weeks, there are numerous publications. We talked about the site map, the FTB site map, which we're going to jump into in earnest next week. But your instructions to the Form 540 are also a go-to document, in addition to the other items that are published by California for the VITA program. And there's a number of them. And then we already talked about the 3854. Okay, so let's talk about these changes for the volunteer tax alert. And I know you've got a copy of it. If if you checked your email in the last few days. So let's go ahead and see if I can bring that up. And Sean, I'm going to call on you. And if you can let me know if you can see the screen that says volunteer tax alert.
Yes, we see it now.
Okay, and so this is the first one that came out, and it talks about the 6744. And you can do business any way you want, because at the end of the day, your site coordinator wants you to be certified, and that could be at the volunteer standards of conduct level, or it could be, again, my site, you got to be certified at the military level. And so what I do when I certify, of course, I've got my reference materials, my publication 4012, and then I'll go to that form 6744. And what it is, it's questions that are similar, very similar to your electronic certification. And so what that means is if you take that form 6744 and look at the answers to the questions, or prepare a return and then answer your questions on the 6744. Then when you're ready to certify, it's a matter of taking your 6744, opening up Link and Learn, because we certify electronically, and simply plugging the answers into Link and Learn from the 6744, and then hitting submit. And if you've looked up all of your answers, did you returns correctly? You most likely get 100%, or certainly hit the 80% passing. Okay, so here are some of the changes, and it talks about the message to volunteers. So this is the pen and ink change you'd make to your 6744, and it talks about the scenarios. The basic is your first level of certification for a tax preparer, and it talks about scenario number 3. There's various scenarios for each certification, and so you can see that Ian's age should be 17, so you make that change. It talks about scenario 7. You're going to make a change to the SSA 1099. The SSA 1099 is issued by the Social Security Administration to individuals that have received Social Security benefits. So you make that change. Scenario 9, there's a change regarding a savings account, i.e. a number. And when you're talking about bank accounts, every bank account is going to have a number. And then every bank account is going to have an American Bankers Association, and that would be a routing number. So you got a routing number and account number, and that's what we ask our taxpayers, in addition to what type of account, because generally we want direct deposit, and we're going to encourage the taxpayer to get direct deposit. It's quicker and it's safer. Next, I want to talk about the advanced scenario. And the advanced scenario is simply another certification, as we've mentioned. And so I recommend, of course, Sean's in charge of the site, but I recommend individuals certify at the basic level and then go to the advanced level. I've seen it too many times where individuals certified at the advanced level, and then when they're at the VITA site, they have forgotten a lot of things in the basic module from the previous year. So that's my recommendation. Yeah. Sean, did you have any comments about that?
I agree with you. Everybody who takes advanced should start out with basic, because it covers a lot of ground that is not in the advanced exam.
Yeah, and I'm an enrolled agent. I've been doing this for many, many years, and I am stumped every season. So if I don't go through the basic and then jump into the advanced, I'm going to miss something. Okay, so the advanced scenario, number 7, it talks about a missing payer TIN. That's a taxpayer identification number. The EIN is the employer identification number. And so you're going to see that EIN on every type of 1099-R and W-2s also. And then the advanced scenario 7 and 8, it talks about the vehicle expenses, and it says the practice lab, which is what you're going to use to certify, talks about may ask for the mileage to be split into 2 parts. And that's true as of yesterday. And so what that means is that legacy from 2022, the rule was you had a different mileage rate in the first 6 months and the last 6 months. And so if that is the case for the practice lab, then so be it. You'll go ahead and address that. For the live TaxSlayer Pro for our VITA site, most likely that's going to be taken care of because 2023 is different than 2022. In 2023, your mileage rate for business is 65 and a half cents a mile for every mile during the year. And then for the certification, and we know in order to get to that basic certification, you have to start with a volunteer standards of conduct. You get 80% or more, then you jump to the intake and interview. And at this point, I'm on the right-hand side of the page. It talks about the basic certification levels required to prepare a return with unreported tip income. And so if you're a VITA preparer, you'll get that. An unreported tip it speaks for itself. That simply means you have someone who's compensated either in full or in part by tip income. And so think about the waiter or waitress that you tip, the valet that you tip. What that means is whether it's $1 or $100,000 of tips, that's all part of taxable income reported on their return. A lot of people report their tips to their employer. If you don't, then you have to make the appropriate change in your software. So here your test and your retest question. The retest simply means you're given 2 opportunities to take the test. And this is what I recommend, whether you're new or you're a returning volunteer. If you're unsuccessful on one of the certifications, i.e. test, then before you jump into it a second time, go to your 6744 and look up every single answer before you submit it. I've had people in the past who said, well, I've submitted it twice and I failed twice. And what that means is at my site, then we'll have to do a paper test, if you will. But typically, if you look up the answers, you're going to be fine. So anyway, the retest question, it talks about tip income, so you want to address that.
Hey, Jerry, can I just
go ahead?
You were mentioning that at your site, everybody gets certified basic or advanced. And
no, everybody is certified at the basic, at the advanced, and military.
Right. So just in case it's not clear to people who are tax professionals, there's another certification called Circular 230. And that doesn't actually qualify you to do anything except to get continuing education credits. You still need to do basic and advanced if you want to prepare tax returns.
Yeah, for the tax professionals out there, and again, I've seen this time and time again. There are all different types of tax professionals. If you're going to volunteer at a VITA site, you can take the Circular 230 exam, but you want to take the basic and the advanced. And so I require everybody that works on my site, whether they're a CPA or an attorney, to certify at the basic, the advanced, and the military. Now, what I do is I certify in the Circular 230 in addition to those other certifications. And what it is it's simply going to jog your memory because I've sat down with CPAs and IRS revenue agents and enrolled agents, and they flunked the basic or they flunked the advanced because maybe they're working with corporate returns and they don't work with individuals. So the whole idea is you want to have a trained cadre and you want to have individuals who are able to do quality review. And that's why I think it's so important. And I recognize it does take some time, but get the certification. You got plenty of time. The site doesn't open up until, I think, Sean, you open up what, third week of January?
That's right. January 20th, I think, third week of January.
Yeah, so plenty of time. And if you are a tax professional, going through this is not a bridge too far. You can probably knock out most of these certifications in, an hour, a couple hours. Okay, moving on. So the over-the-phone interpreter, that's also one of those certifications. And there's a change there indicated regarding response A to a particular number. And then the resources, again, you have lots of resources. Probably one that's going to help you out is that publication 4491, and that's your VITA training guide. And typically there are changes to the 4491 when the season comes about. I don't use the 4491 that often, but again, it's a good publication. It's worth using. So anyway, here are the changes that came out recently regarding the form 6744, and that form. Sean, let me ask you, did you get copies of those also?
Yes, we did for all the St. Killian people.
All right, very good. So then you can make what are called the pen and ink changes in that particular document. And again, if you're new or newer to VITA, I think that's the way you want to go, because taking the certification electronically without the form 6744, you're probably, I don't know if you're at a disadvantage, but it's just it's just more organization. It's better to use the 6744. Okay. Let's go ahead and stop that and jump back to our presentation. Oh, any questions regarding the 6744 or the levels of certifications that we've been talking about? And Sean, if you can monitor the chat.
There's nothing in the chat.
Just a general question for the newbies here. The exams we're taking are online exams.
They are. Yes.
They are open book exams.
Open book and untimed. So if you get distracted,
Oh,
come
good.
back the next day. Like one day I was going through a certification. I heard a bird chirping. I became mesmerized by the bird, and an hour later I came back to my certification and completed it.
And then you said we get 2 attempts. Is that what I heard, right?
You get 2 attempts electronically. And so what that means is if you're unsuccessful on that first attempt, go back to your 6744, look up all of the questions in the publication 4012, and then you can jot it down in your 6744 and then take your second attempt and you'll be successful. And you need 80% on each one of those certifications.
And when if you do fail, are you given any details in terms of what sections or what percentage you received or what?
Sure. You get the feedback when you submit your certification. You get the feedback, so you want to review that feedback. And then what I would do is I would have my hard copy 6744 sitting next to the computer. I'd go through the various items that were unsuccessful, and then just make note and then look up the answer.
And Jerry, there's a question in the chat about if you leave in the middle of the test, does it remember where you left?
Yes.
It does. It does. Yeah, it does. Yeah.
And I would recommend that if you do that, make sure it's just a good practice when you're doing electronic exams before you hit submit. Just make sure you've answered every question.
That's true. Yeah. As my former boss used to say, anytime you're looking at a document, whether it is an electronic document or a hard copy document, start at the top and address each and every issue and go all the way to the bottom. And I can't tell you how many times that I have taken a test and did not respond to all of the questions. So yeah, it's a good point.
Where is do we have to call like Prometric, or is it on site at like St. Killian's, or?
No, it's publicly available. Once you register in Lincoln Learn to take the certifications, then you have access at home in front of your computer, and then you simply go through the certification.
Jerry, this is Barbara Harris from Laguna Woods. This year, Lincoln Learn has gone to a new provider, and we all should have gotten an email to log on. I've had one counselor who was able to go through the certification. When I started, when Christine from the IRS tried to get in, and when one of my key counselors tried to get in, there was a lot of problems. I went through the first step, ethics or whatever it is. They did not provide whether or not you got the answer correct or not. And then the whole application shut down. And then VITA sent out a notice that it was down due to maintenance. And I am not sure if it was supposed to come back up yesterday, but I haven't tested yet. And I wonder if anybody else has. The old Lincoln Learn is not there anymore. So you have to register in the new application, and they send you an email for verification, and then none of your information is carried forward. So you have to re-enter all that stuff again.
Yeah,
So
I
I don't know what the status is. I was going to try later today.
It's not
It's
open.
still
Yeah,
down.
I tried this morning. It's
It's
still
still
down.
down.
Yep.
Yeah, I went in yesterday and yeah, it didn't work. But the bottom line is you do have the contractor and you have the IRS working these issues, and that does happen from time to time. Usually the IRS misses the projected date where they're going to launch the new year. So I think the word is you want to be patient, and it's great to certify early. I do know that we have one volunteer that's certified early. Again, that's great. But you do want to make sure you keep on it, because by the middle of January, you want to make sure you're certified at whatever level you want to be at. And then you want to get that 13615 for tax year 2023 to Sean, so he knows the level of certification. And then another thing that I've mentioned before on that volunteer standards of conduct, your phone number is important, because sometimes your site coordinator needs to call you to tell you, hey, we need you, or no, we don't need you, or something's changed. And so I always recommend to volunteers to provide their telephone number, and that way your site coordinator can call them if need be, or text them. All right, Sean, any more questions for chat?
No, Jerry, that was it.
Okay. All right, and then we're going to get through our welcome and introduction. These are the, as they say in Broadway, this is the cast of characters. And so Christine is an IRS employee, and she is the one who administers the VITA program in Orange County, or at least a portion of Orange County. And last time I looked, I think she was based in Los Angeles. And then we have our Orange County United Way representatives, Raven and Omid. And then for the VITA team, Sean, I think I've listed all the names that I possibly can think of. If there's any new ones, you might want to mention that now.
I will just let you know, Jerry, that we'll probably be changing Raven Gates on the Orange County United Way. She's been assigned to a new role. They're in the process of interviewing her replacement right now, but we don't know who that is.
Okay. Yeah, last time I talked to her, she was in the saddle for Orange County United Way, but okay, very good. And I know Omid, he's got a lot of knowledge. He's been around for a number of years, and he's still involved. Okay. All right. And so with that, let's move to our next slide. Again, the TaxSlayer Pro, also known as the practice lab, when that thing comes up and it's operational, then you'll be able to conduct your certification. And as of last night, I checked the practice lab, and I was able to, or yesterday, I was able to use the 2023 tax software. And this is important. I've done it probably 100 times. When you jump into the software, you want to make sure you're operating the current year. And so for the current year, we're going to be in 2023 tax year. And sometimes you're at the VITA site and maybe you've got a 2022. So just make sure that you indicate that. And in the software, you go to the upper right-hand side and you simply indicate what year you want to prepare. And as of yesterday, the state tax return for California was not yet available. And this is something that we don't do at the VITA site in California, or at least the St. Killian's. We prepare a California return. We prepare a federal return. We're not going to prepare other states. That's outside of the scope. And then for your practice lab, once you get to that landing page, there are tutorials. If you're newer, it might behoove you to use some of those. And that would be section 4 on that landing page that we talked about. And there's also practice returns and solutions, or what are called check figures. And your practice return, if it has a fact pattern that's married filing separate, you could ignore that, because we at the VITA site, we don't do married filing separate returns. And we see that time and time again. People come in, they go, well, why not? And we simply tell them, we're not trained to do it. And your options include going to someone who can help you, but at St. Killian's, we don't do the married filing separate return. Okay, so let's talk a little bit about a reverse mortgage. And full disclosure, I'm eligible for a reverse mortgage, but I haven't signed up for one. And I don't know if I will sign up for one. So This is just based on information I was able to obtain. So when you're talking about a reverse mortgage, what that means is your individual has to be 62 years or older. And of course, then they have to qualify for a reverse mortgage. It's not automatic. Individual has to have equity in their home. And not everybody has equity in their home. I've met a lot of seniors. I met guys who are 75 and still had a mortgage and had no equity. But typically, if you're a senior, you probably have some equity in your home. And then when you're talking about a reverse mortgage, they're loan proceeds. And so there's different ways that the contract or the promissory note will provide. But at the end of the day, you're receiving typically a monthly payment, and it's a loan. And you're paying interest on a loan. You're paying fees. It's not income. It's not taxable income. And then that item that says the borrower loan proceeds can be in different types. And so again, based on the contract, could be a lump sum, typically monthly advance. That's what I've heard, or it could be a line of credit. The whole idea behind a reverse mortgage is you've got a senior and maybe they've got limited income and they realize they've got equity in the house and they go to a bank and they say, hey, I want this monthly advance, whatever, $500, $1,500, whatever it is. And that helps them enjoy their lifestyle, pay bills, things like that. But yes, it is a loan. So that means at the end of a certain period, and of course that loan has to be paid back either by the borrower or an individual that is responsible for that particular property once the borrower passes away. And so this is something that's good about a reverse mortgage. And I've read a lot of good stories and I've read a couple of nightmare stories about reverse mortgages. But you're able to live in your home because you still have title to your home, even though you've got a loan in your home. It's kind of like when you buy a car. You buy a car and you've got a car loan and you owe a whole bunch of money on your car. You still have title to your car. Now, if you don't pay the loan, then of course there are consequences that the car company can take. But any item, this is a secured loan because there's a home. And then this is your takeaway for VITA purposes. Reverse mortgages are not a taxable event. So someone may come in and say, I've got a reverse mortgage. Okay. And then again, it's not taxable. Now, when you're talking about a reverse mortgage, it simply means you have principal and you have interest that you're paying. And typically that's going to be paid at the end of the period. And it could be 30 years. A lot of stories I read of 30 years. And so that means the individual at the end of 30 years, they've got to refi or sell their home, or if they pass away, then of course maybe their adult son or daughter then will either sell the home or pay off the mortgage and then retain the home. And then here's something that you'll see in that publication we talked about. Interest accrued on a reverse mortgage is not deductible until it's paid. And so that means, again, at the end of the period, or perhaps when the senior has passed away. And then the bottom item, the last item, talks about deduction of interest. And we know generally you can deduct interest on your home mortgage. That's the general rule. There's many exceptions. And the takeaway here is your deduction of interest may be limited because a reverse mortgage is subject to the home equity debt rules, which are not deductible. And so what I would do, again, I don't profess to be an expert on reverse mortgages, but if someone comes in and says, hey, we've paid some interest on this, then I would ask them a number of questions and I would jump into that publication, that IRS publication that talks about the home mortgage interest deduction. And I'm going to throw it out to the crowd because we got people here who probably have a reverse mortgage or worked with it. So, Sean, can we query the crowd? Anybody who worked with a taxpayer who had a reverse mortgage that paid the reverse mortgage? Can we ask them what they did at the VITA site?
Well, Jerry, I happen to have done this once about 2 years ago, and we determined that the person had taken out a home equity line of credit and only used it for supplemental income. So the interest paid was not deductible because none of it was used to buy, build, or improve the home.
Okay.
And the
All right. So
taxpayer was not very happy about that.
yeah, and again, what I've done, because you're going to have individuals that simply don't believe, or maybe they're frustrated. And so if you show them an IRS publication and you go to the chapter and verse in that publication, they still may not be happy, but at least they understand, okay, this is the rule. And that's why it's great to, bring a publication up on your computer screen. Now, if you just want general information regarding a reverse mortgage, Federal Trade Commission, they've got a website. They do a pretty good job talking about reverse mortgages, and you can see that URL at the bottom of the screen. Okay, any other comments or chats about reverse mortgages?
Well, Clayton was just saying that RICP that he has is specializing in that sort of thing. So
Yeah, there's a concentrated section is, I don't know, about 270 hours of course study. And part of it was on reverse mortgages, the various benefits in that. But I think it's probably beyond the scope of what we'll be talking with any of the people that come in for our assistance doing VITA.
Okay, and then someone invoked an acronym RICP. Can you tell the crowd what that is?
Yeah, Retirement Income Certified Planner.
I learned something.
I'm a financial planner. I've been in practice for 17 years. And that designation is concentrated in people that will be, hire, people that are retiring and, making them sure that they never run out of money and ways to generate the most efficient income possible, that type of stuff. So.
Yeah, that's a good point. I can't tell you how many seniors I've bumped into, and for whatever reason or reasons, they're at a point where they're either running out of money or they've ran out of money. I think probably the most, I don't know if it's tragic, it's just a story. There was a guy that I heard of, he was 99 years old. Good for him. And he ran out of money, so he had to go back to work. So you do see that from time to time.
Yeah, so that's where the knowledge and the reverse mortgage comes into play, how and when best to use Social Security, but that's not stuff that we'll be talking to our clients is like, hey, you're taxed here and you're not taxed here. So
I've got a question that's not reverse mortgage, but with regards to the situation where someone doesn't like what you're showing them in the tax thing, they think that they should get their interest deducted, etc. If someone doesn't like what you're saying the rules are, is that where you say they need to prepare themselves or go to a preparer, or how do you deal with that conflict where you're wrong?
Yeah, you're going to have that whether they're a youngster or a senior. You're going to have people that push back, and so what I do, this is what I do at my side. I try to be patient with the individual. I try to go into an education mode, and then I try to find a document, a government document that explains it, i.e., an IRS publication. And at the end of the day, if they don't like it, and I've had people disagree with me, says, Jerry, I think you're wrong. I think the document's wrong. I'm thinking, okay, well, if that's the case, then what do you have to show? And again, use care bear language, of course. But at the end of the day, if they don't want you to prepare the return or they don't agree with you, then you can say, well, I'm sorry, we can't help you. And then, they can go out in town. They can go to another site. AARP's got a lot of great sites. Or if they need a tax professional, they can go ahead and get a CTEC person, a tax CPA, and enrolled agent. And there's a lot of different ways. But as we've mentioned before, do not recommend a particular tax professional. What I do at my site, when people say, well, where do I go? You guys can't help me. I need a tax professional. Then I invoke the California Society of Tax Consultants. It happens to be a society of thousands of members in California. And they can go to the website and they can punch in their zip code, and a laundry list of preparers will come up, and so you can refer them to a site, but not an individual preparer. Okay.
Hey, Jerry, can I mention something at St. Killian?
Sure.
So if there's a situation that comes up where there's a very difficult taxpayer, we will always have at least one site coordinator on the premises, and usually 2 or 3. And just when you feel like somebody's being too difficult for you, just get a hold of the site coordinator and we will deal with the difficult people.
Yeah, and typically most people are appreciative. I've been in the program for many years, and so sometimes you got someone for whatever reason, they're just not going to take no for an answer, and so that's when you again use your skills of diplomacy, and you tell them we can't help you for this particular reason, and then here are some options that you have, and then that's the best you can do. Once in a blue moon, you have someone who's disruptive, and at that point, you just say, "Hey, again, Care Bear language, but you got to leave. We've done what we could for you, but you got to leave." And one thing that I refuse to do at my site, I refuse to be intimidated. But again, it doesn't mean I'm going to be overbearing. I'm simply going to explain myself to a taxpayer and say, this is not for you. Here's some options for you. And you can throw out someone who's being disruptive because this is not part of the program. We're not going to sit there and have a shouting match with the taxpayer. Again, be professional, be diplomatic. But at the end of the day, they're going to leave. Okay, Sean, this might be a good time to take a break. I've got 9:57 before we get into the information returns.
I just there's one question in the chat. Somebody was asking about the home interest. If the taxpayer says that it was used substantially for improvements, what kind of proof do we ask for? And in general, we never ask for proof. That's their responsibility. They're legally liable for whatever statements they make. If they tell us it is, they might need to have that proof if there's ever an audit, but it's not our job to be auditing their records.
No, we're not going to do that. If they provide a statement, we're simply going to say, okay, if that is the case, you want to maintain your documents. In the unlikely event you get examined by the IRS, the examiner will ask for documentation. So yeah, that's what we do. We're not auditors.
I mean, in the case of somebody has become disabled and makes a ramp or something like that, then that's obvious. The auditor goes to their house and okay. Yeah, okay.
And again, the IRS, and I use the term facts and circumstances. Everybody, tax returns are like people. They're all different. And so if someone says I did X, then some probing questions, and if it meets the mail, if you will, if it's allowed, then that's what we're going to do. Okay, Sean, I've got 9:58. How about we take 10 minutes and come back at 10:08?
Sounds great. I'm going to pause the recording.
Okay. All right, we are back. Sean, any comments or announcements? Okay. All right, so let's talk about the information return. This is the 1099-K, and you may have seen this before. And as it says on the very top of the screen, it says, this is a report of payments that a taxpayer would receive for goods and services that they have provided to an entity of some kind. And so what I've seen the 1099-K for individuals who have received Zelle payments for work they have completed. I've seen it for drivers, i.e. Lyft and Uber. And then there's also what is called a third-party settlement organization. And so basically an intermediary. But at the end of the day, what happens is a taxpayer is providing goods and services, and the 1099-K is then issued to the taxpayer, and that'll be for the amount that they provided. Now, the rules for tax year, or excuse me, the rules for 2024 coming up here pretty quick is the IRS plans if there's a threshold of $5,000, which means if someone has provided goods and services to the tune of $5,000, then there's a requirement for the 1099-K to be issued. You may see a 1099-K issued if someone has received, or I should say, received $600 or more in payments. But that particular rule for $600 or more is going to be pushed off for another year. Typically, when you're talking about changes, usually the IRS will implement them, and sometimes it takes a couple years to work out the kinks. But you may see a 1099-K, and again, it's an information return, and you're going to ask those probing questions. Why did you get this? What does this represent? I think it's important with certain information returns to ask the taxpayer, what did you do to receive this? And in some cases, the taxpayer may say, I didn't do anything. This is issued in error. And that's when you go back to that organization that issued it and say, hey, I need an amended one. Or certainly on my site, I'll do the probing questions, say, okay, well, if you receive this document in error and we determined that or confirmed it, then this particular item is not going to be reported as a taxable event. But you're going to see more and more of these as the years click by.
Hey, Jerry, can I make a comment here? And it's probably not going to be applicable this year, but when eventually it has this $600 figure, you know, if you go, for instance, you go to Venmo, this is probably younger people, right? You go out to dinner, instead of everyone paying cash, one person pays and then the other person just pays a bunch of Venmos, right? So you do that all year, you're going to have $600. None of that is taxable at all, right? It's just you're splitting up the expenses. But we're going to be getting these forms, and it's I think the error is going to be the other way around. It's like, oh, I don't know what it is. I should put it in as income, as opposed to figuring out what exactly did you provide services? Where did the 600? So it may not be an error. It's just not what you think it is.
Yeah, and that's why with information returns, I mean, I'm not an expert, but I've been doing this a long time, and I like to ask lots of questions. And if the person has that information in their brain or on pieces of paper, then they can answer those questions. But you see a lot of different things, and it's okay to ask those probing questions. The IRS does it when they audit you. And as a tax guy, for my clients, I ask them questions, and sometimes I make a determination the document they have is not a taxable item. And that's important. Yeah, John makes a good point. You ask the questions.
Hey, Jared, just a quick point. You said that the 1099-K could be an error, and that's when you go back and ask for an amended document, but the taxpayer would do that. That's not going to be a VITA responsibility. We don't advocate for people.
Oh, that's correct. Yeah, like I mentioned before, we do not advocate for our clients. We're not going to contact the IRS on behalf of the client. We don't do that. Now, as I mentioned last couple of weeks ago, we will point the way for them if they say, "Hey, what should I do?" You give them some options, but at the end of the day, a lot of this stuff is the responsibility of the taxpayer. So they've got to make the phone call, send the email, or knock on doors. All right, let me go ahead and unfreeze that and go to our next one. And then another document you'll see from time to time is the 1099 MISC. And this is issued to taxpayers for all sorts of reasons. And we'll focus on a couple of things. And this information right here on the screen is right from the IRS website. And so typically the 1099 MISC means the individual is not going to be an employee of the entity. And typically, let's say you win a prize or an award, and not all prizes and awards are taxable. Some of them are non-taxable. And so that's where you have to get into the Pub 4012 or the Publication 525. But typically you'll see this when someone has won a prize or won an award, or maybe they've got other income payments. And when you're talking about income, you, of course, you have to determine whether or not it's taxable or non-taxable. And if someone is performing work and that work is self-employment, usually they're going to get a 1099 NEC. But entities that issue documents, sometimes they'll issue an MISC vice a NEC. But again, when someone comes to the site and they say, hey, I got this document, I received this document, you're going to review it. You know it's an information return. And then again, those probing questions, why did you get this document and what does it represent? And then if the taxpayer can say, oh, this represents a prize that I won at a local mall. Okay, well, tell me about the prize. Well, I won a 4 or 5 pots and pans from a store that I entered a contest. That's a taxable event. And we may have mentioned this before, when you receive prizes, i.e. a television, pots and pans, there's two ways to do it. You can report what's on that 1099 MISC, or you can report the fair market value. So for example, let's say go back to the pots and pans. You've won $1,000 of pots and pans, cookware. And then you go online and you determine all of those pots and pans can be purchased at another store for $700. Same make, same model, same year. Then you have two choices. The first choice is you can report the dollar amount that appears in the 1099 MISC, or you can report the value of those pots and pans that are advertised at another store. Most people will say, yeah, sign me up for the $700 vice the $1,000. But again, you want to ask those questions, those probing questions. And you don't want to be assertive with the taxpayer. You just want to say, hey, what does this represent? Most taxpayers will probably tell you, I did this, I did that, and this is why I got this particular document. Other income payments, again, this is not a document that's issued to wage earners. Wage earners are issued the W-2, so this would be self-employment. That's typically what you're going to see, prizes and awards and other payments.
Jerry,
Yes.
a question regarding the prizes or the awards. If it's a different amount on what they file for taxes than the 1099 MISC, is that a flag for the IRS to contact them?
Yeah, what may happen, the IRS, after the taxpayer files a return, they may send them a letter and say, dear taxpayer, your 1099 MISC said $2,700, and you reported $1,700. And why is this the case? And then the taxpayer says, oh, that's easy. And of course, I recommend, and again, we're not going to do it for them, we don't advocate, but I recommend to the taxpayer, you can call the IRS all day long, but send them a letter. You still call them, but send them a letter. And in this case, you'd say, IRS, I received pots and pans as a prize. I looked it up the same day I got these pots and pans from store A. Store B has these for sale, same make, same model, same year for $1,700. And so that's why, according to the IRS rules, I only have to report the fair market value. And so, yeah, that would be a letter. And yes, you'd have to, taxpayer would have to gin it up. And this happens all the time. I'm a taxpayer like everybody else. I get letters from time to time to the IRS and they go, Jerry, what is this? Can you explain this? Sure. So I sit down, type up a letter, send it off to the IRS, keep a copy, and that answers the mail.
And I would assume, not advocating, but you'd recommend that they do a hard copy of all these things so that if they are questioned, they have that thing, because prices will change over the years.
Yeah, keep your documents. That's correct. Keep your documents. I write letters for clients. Of course, I advocate. They pay me, and then what I do with my clients, I said, "Hey, these are your documents. Retain them." And of course, I retain them as a practitioner. We are not practitioners in the VITA program, so the taxpayer then, once you show them the way and make those recommendations, it's up to them.
Jerry, one more thought. I guess when I see something that's unfamiliar to me, like a lot of these items, I want to make sure, one, am I certified to do this? For instance, rents, depending on the nature of rent, you've got to be military certified, right? To do rental income.
Correct.
And then,
Correct.
And then there's a scope issue, right? Are some of these completely out of scope for VITA? And then, you look at your 4012, it's got that nice little chart that I check all the time just to make sure it's like, I'm sorry, we just can't do this. Or check with your site coordinator. Yeah.
That's an excellent point. You definitely want to stay in scope. And again, I think my wife puts it best. Taxpayers to ask her, well, why can't you do this? And she said, well, think of your brake mechanic. And let's say your brake mechanic is not certified for certain types of brakes. Do you want your mechanic to work on brakes where he's or she is untrained? And the answer, of course not. And so same thing in VITA, we have things that are in scope and certain things that are out of scope. So you want to go to your 4012 when you're not familiar with it and say, okay, is this thing in scope? If it's in scope, we can help you out. If it's not in scope, you're not going to do it. And it may be painful for the taxpayer to hear that, but at the end of the day, we are not trained on a lot of things in the VITA program. And then I mentioned Section 61. I talk about this in my tax classes all the time to my students. And again, we don't plan on making you experts at tax. You're going to be familiar with tax, but at the end of the day, if you have an income item, you have to determine, number one, if it's in scope. If it's in scope, then you have to determine if it's taxable, non-taxable, or taxable in part. And that's important. And again, typically when you ask people questions about their income, this has been my experience. Most people know about the income they receive, whether it's taxable or non-taxable. They certainly know about the income. And so if you ask some probing questions, you're going to be able to determine, okay, this is a taxable event. And some people may think, well, no, it's not a taxable event. Based on their representation, based on the information return, you can say, well, yes, it is. And here it is in the 4012. And like, for example, reimbursements, you get medical reimbursements. Your medical reimbursements are not a taxable event. When you get reimbursed by your employer because you're incurring expenses on behalf of your employer, that's another example of something that's not a taxable event. So it's okay to ask questions, and you're gonna document that, and then you're gonna explain to the taxpayer, hey, this is in scope, and this particular item that appears in your 1099 MISC is taxable, and we're gonna find a place in the tax return to put it. Okay. All right, and for some reason, my screen has frozen again, so let's unfreeze it. And then the 1099 NEC, it stands for non-employee compensation. So what that means is they're not an employee. And there's different terms that are used for non-employees. Some people use the term independent consultant. I use the term self-employed individual because in my studies of taxes over the many years, there's three types of taxpayers. You may be all three. You have wage earners, you have self-employed individuals, and you have investors. I can't think of another type of taxpayer. And so for the NEC, again, this will cover an individual who's not an employee. And so typically that would be someone who's self-employed. And of course, when you have self-employment, that's going to be that Schedule S, the Schedule C as in Charlie. And you're going to report that self-employment and then any ordinary and necessary expenses pertaining to that income on the Schedule C. And so as it says in the second bullet, this is typically used when payments are made to an individual in a trade or a business. So for example, I'm a tax guy, among other things. And every once in a while, I'll have tax professionals work for me. I'll give them an assignment. And the only thing I'm interested in is the end state. I don't care where they do it. I don't care when they do it, how they do it. I just need the end state to be completed, whether it be they're going to do research in tax court cases, and they're going to present me with a white paper. And that would be an example of a non-employee, and I issue them a 1099 based on what I pay them during the year. And of course, then what they would do on their Schedule C as in Charlie, they would report that income and any expenses. Now, this is something that we don't do in the VITA program. There's a lot of things we don't do. We do not prepare any 1099s. If a taxpayer says, well, I'm a Schedule C, well, if you're a Schedule C and you've issued 1099s, then it's incumbent upon you to prepare the 1099 and give it to that taxpayer. We just prepare the returns. We don't prepare in 1099s. And I think I see more and more of these 1099 NECs. There's a lot of things I see more and more of in VITA. Certainly these information returns, the 1099K, the 1099 MISC, the 1099 NEC. And then for some reason, I see a lot of people who gamble, and some of them are unsuccessful, some of them are, but there's just certain trends you're going to see more and more of. All right, Sean, any questions about the information returns?
I do not see any questions in the chat room.
Okay. Okay, then let's jump into the child tax credit. And the good thing about the child tax credit, as it says at the very top, this is going to calculate automatically in your software. All you're going to do is you're going to indicate the dependent. If someone does have a dependent, and you're going to go through the software, you're certainly going to report their social security number. You're certainly going to report their date of birth. And this is important. I've seen it many times where taxpayers, and it befuddles me, they don't know the date of birth of their child. And that could be for various reasons. And so you want to make sure you get the date of birth. And sometimes mom or dad is going to say, well, gee whiz, I don't remember. Well, then there's certain documents. And of course, the go-to document is a birth certificate. And if they live local, they can call their wife or husband and say, hey, what's the age of Junior here? But you have to do that because when you file a return, in order to get the credit, they've got to be under age 17. And also, if you put the incorrect date of birth and or the incorrect social security number for a kid, then what happens is when the return is electronically filed, you're going to have a rejection, which means then someone in the VITA site has to perfect that return, i.e. contact the taxpayer and say, okay, what's the date of birth of your kid, month, day, and year, and then what is the social security number? And that's going to happen every once in a while. So again, probing questions, and if someone has any doubt, there's typically a document sitting at home, and you'll be able to verify that. So again, back to the child tax credit. This credit in tax year 2023 is completely, let me restate that. This credit in 2023, there's a maximum amount. And again, it's under age 17 at the end of the tax year. Our tax year in VITA is defined as December 31st because we only work with calendar year taxpayers. Every once in a while, you're going to bump into a fiscal year Form 1040. We don't do those in VITA. It has to be a calendar year. Another rule is they have to be a U.S. citizen, resident alien, or a U.S. national. We rarely bump into U.S. nationals in VITA. An example of a U.S. national is someone who lives in the Northern Mariana Islands, way out in the Pacific. So again, we usually work with U.S. citizens or resident aliens. And of course, your child has to be claimed as your dependent, so you have to meet all those dependency rules. And then typically in the VITA program, when you're talking about a qualifying child, it's usually going to be the son or the daughter. That's typically what you're going to see. But on item number 4, you can see a laundry list of dependents. It could be an adopted child. It could be a eligible foster child, or it could be what is called a lineal descendant. And so that would be like your granddaughter, your grandson, something like that. And then the qualifying child under age 17, they can't provide more than half of their own support. Typically, when you're talking about someone under 17, usually they're not providing any of their support. But every once in a while, you'll bump into someone, a young person, and they are providing more than half of their support. Maybe they're working. I've seen 16-year-olds making more than their 45-year-old parents. And so again, you have to ask about support. And then another rule, they have to live with the taxpayer more than half of the year. And of course, that would be about 183 days, something like that. And then of course, they have to have a social security number that's valid for employment. You're typically going to see someone with just a regular social security number. And then sometimes you'll see on that social security card, valid for employment. And that's why we ask for social security cards, because some people can't remember their social security number. They may be an immigrant to the United States and then they become a U.S. citizen, and they're not thinking like guys like me. I grew up with a social security number as a little boy, and you have that memorized and you use it all sorts of places. So again, look at the social security card. And then some people ask me, Jerry, what about an electronic version of a social security card? Sure, you take a picture of your card, that's acceptable. And again, we want to look at the hard copy or the electronic version of the social security card. I'll mention this. Some people lose the social security card. You can go to the Social Security Administration, and it does take a while. They're not going to generate the card that same day typically. and you can get a replacement. I did that one time. I lost my card. I was a young adult. I'm thinking, well, I want my number here. I want my card. So I went down to the office. I showed them my driver's license. They looked me up. And then I think about a week or two later, they sent me a new card. Well, is there a comment?
Yeah, Jerry, there was a couple of questions in the chat. One, if somebody turned 18 in the tax year, in the middle of the tax year, do they get a partial tax credit for that year?
No, they
dependent
have to
child?
be under 17 at the end of the year.
Okay, and then the other question goes back to the NEC, the 1099 form. The question is, if somebody got less than $600, is that still reportable income?
The short answer is yes. Remember Internal Revenue Code Section 61, everything's included in gross income unless otherwise excluded. And so, for example, let's say you have a bank account and you got money on deposit and you received $9 of interest income. Maybe the bank is not going to issue a 1099 INT, but you still receive $9, and that is considered income because, again, everything's included in gross income unless otherwise excluded. And then you had one more, Sean?
No, that was it.
Okay. All right. So again, this is automatic, and here's another thing I'll offer. Taxpayers, when you complete their return at the VITA site, there is a courtesy return that is printed out. And a lot of times you're going to go through the very basics of the return. You're not going to spend 8 hours with the taxpayer going line by line. You're just not going to do that. They're typically interested in what do they owe or what is their refund. And so you spend a short period of time with them going through the return, certainly addressing refund and or what they owe, and then maybe some other ones. But I don't think you want to get into the practice of spending a very long time with the taxpayer going line by line. But if they ask about the child tax credit, you say, yeah, here it is on this line right here. This is the dollar amount you're getting. Okay, the additional child tax credit, and it says on the screen here for very low income individuals, and if they have a child, they may get that. It's limited to $1,600 for each qualifying child. And if you have, and we have this in VITA, we have moms and dads with 4, 5, or 6 kids, and they're very low income, and so they're going to be entitled to this additional child tax credit. And then this is something that you may get a question of, and I get this every season. Taxpayers say, well, I did this last year, the year before, and I did not get my refund right away. And the reason for that is the IRS, they're verifying things, and that's why they say the refunds before mid-February, meaning the IRS is going to spend some time verifying these particular refunds. And so that, I think that happened, I think that started about 10 years ago. And if someone does have an issue about not receiving their refund, they may call us at the VITA site, and we simply refer to them. Say, hey, go to the IRS website, call the IRS. Typically, calling the IRS or checking the website for where's my refund. But again, we don't get involved. We don't advocate and hunt down their refund. That's not part of our duties. And then at the very bottom, it talks about someone who files an amended return because they finally get the valid SSN for the child, and it's issued after the date of the tax return being filed. Well, in that particular case, they're not going to be eligible for the advanced child tax credit. And again, this is pretty much automatic, and it's a good thing for the low-income individuals. And here we go.
Just to understand the difference between the two different child credits, if you go back to the slide you were just on, that has its you said that if they have 3 or more childs, they're eligible for additional tax credits regardless of their income. So I'm a little bit confused about when the additional one occurs or when it doesn't occur. Seems like it always occurs if they have 3 or more children.
Yeah, if they have 3 or more children, you're going to see that. And so this is automatic. This once you enter the children into the software, then this will populate on the return. And if you need details about this, your publication 4012 or the child tax credit publication talks about this in detail. All right, credit for other dependents. If I remember correctly, I think this came about with the Tax Cuts and Jobs Act of 2017. And so what you may get these legacy taxpayers that have been filing returns for 10 or 15 years, and they may be familiar with the old rules. And so this is one of the new rules. You have an individual who's not entitled to the child tax credit, but they may be entitled to this credit for other dependents. And so they have to meet certain rules. Again, they've got to be a citizen or a resident alien or a U.S. national, which I think I've seen maybe once or twice in the entire time I've been involved in taxes. So you just don't see it that often. And then they have to have what is called a valid ID number. Typically, most individuals will have a social security number, or they may have an ITIN. And an ITIN is an individual taxpayer identification number. So what happens is you might have individuals who are here in the United States legally, or you might have individuals in the United States who are here illegally. There's different terms that are used, typically the term undocumented alien. And so what happens is individuals will, when they file their return, they're certainly going to provide the IRS with their name, but they also have to provide an ID number. Kind of like your credit card. If you have a credit card, you got a name on the account, and there's a credit card number. Same thing here. And so most individuals have an SSN or an ITIN, but you have to apply for an individual taxpayer identification number. And not all, but a lot of undocumented aliens will apply for the ITIN because a lot of them know that when they're here in the United States, they meet certain rules. They have to file a Form 1040, just like you and me. And so that word is out. I see a lot of undocumented folks, and they know they've got to have an ITIN to file a return. And that ATIN, that's the adoption taxpayer identification number. Sometimes you may see that, but they have to have a valid number. And then this particular credit is non-refundable, which simply means it's a dollar for dollar reduction of the tax, which is a good thing. And then, of course, you have individuals who live in Mexico or Canada, and those individuals are not going to qualify for the child tax credit or the credit for other dependents. And this is automatic too. You're going to plug in the information regarding the dependent, and this will appear on the return, or it won't appear on the return based on the information that you've entered.
Jerry, there's a question.
Sure.
Is there an income cap for taxpayers to qualify for these child income tax credits?
There is, if I remember correctly. But what I'm going to do, because I don't remember everything, I'll look it up on the break, and most likely it's in the 4012, and we'll share that with you when we come back.
And I'm pretty sure the
I
limit.
guess it's above the VITA limit.
Yeah, it's way
for
above
tax-
the VITA limit.
Yeah, and that's you'll hear the term phase out, and sometimes when people say, "Why am I not entitled to this particular credit?" Like, for example, the earned income tax credit. Well, when you make a certain amount of money, Congress says you're not entitled to this credit, and those are called phase outs. And there are many different types of phase outs on a tax return. Anything else, Sean?
No, just like Jerry said, or John Nagy said, our limit for clients at the VITA program is 1/2 of the average income for Orange County, which is about $64,000 this year, and nothing phases out at $64,000.
Yeah, I can't think of anything, but one thing good about the software, when the software is written correctly by the guys and gals, the phase out will occur. And that's also a good point when you're talking about the limitation. Typically, what happens is this limitation, i.e., the $64,000, that's written in hard jello. And so, for example, I'll use my site as an example. You have a taxpayer comes in, they have one W-2, nothing else, and they have $66,000 of income. We'll help them out. Now, if they come in with a W-2 for $150,000, we'll say you are well above the guideline. And so you're going to have to go out in town and get your return done. Anything else, Sean?
I think that's it.
Okay. Okay, now the child and dependent care credit, we're going to see a lot of this at the VITA site. And so generally you're going to have a minor, a little kid, and that little kid's going to be under 13. And then what happens is you're going to work or you're looking for work, or as I mentioned before, you're attending school. There's a plug figure for that in the software. But the bottom line is you're paying someone to watch your child. And I don't know what the rules are in the state of California, but I don't think you can leave a little kid in your house and go off to work and there's no one there. That's a bad thing, and you're probably violating at least one or two laws. But the bottom line is you're dropping your kid off at the daycare center, and they've got to be under 13. So if your child turns 13 during the year, all those previous payments that you've made to someone to watch your child are included in the computation for this non-refundable credit. And so you may have heard and we'll go to the next slide in a little bit here. You may have heard someone paying like $3,000 for their child for childcare expenses. That's not the credit. The credit is going to be calculated based on a certain amount that you pay for that child. And again, it's a non-refundable credit. And also when you're talking about qualifying persons, and I remember we had someone in our office one time that individual had an adult and had to bring in someone to watch that adult because the adult was incapable of self-care. And that's typically defined as they can't dress themselves, clean themselves, or feed themselves. And so that means they need someone to help them. And you see a lot of individuals like that. And I also mentioned to individuals, talks about they have to have attention. So if you leave them at home, them being an adult, and to go to work, and there's no attention, they could possibly hurt themselves. You don't want that. So you bring someone in, and that caretaker is watching that adult as opposed to the child. So this is the incapable of self-care. And so again, that's another example of a qualifying person. And also the qualifying person has to live with you for more than half of the year. And so think of the little kids. I don't think I did this very often, but I remember when my son was a youngster, we had a daycare provider nearby. She was certified by the state of California, which I guess she went through the CPR classes, the other classes. She was licensed. And we dropped them off and then go to work, come back and pick them up, and then pay that individual for their services. And I know some of you are probably thinking, hey, Jerry, for a little kid or a couple kids, it's multiple thousands of dollars for the whole year. And I would agree with you. Childcare is not cheap. But what that means is you're limited in your software to what are called qualifying expenses. And so you'll include no more than the qualifying expenses in order to calculate the credit. And then at the very bottom, there's a publication 503. If you can't find the answer in the publication 4012, and this is certainly in scope, you'd go to the publication 503 and look up those special rules.
You talked
So
about the qualified person. Is there any requirements on the qualified provider of the service?
Oh, when you're talking about the provider, like we mentioned before, your provider, as a responsible parent, you're going to make sure they're licensed because that's the requirement in California. You want to make sure that obviously you have contact information. Here's another point when you're talking about that qualifying caregiver. The qualifying caregiver is you're paying them, and that's income for the qualifying caregiver. So it's incumbent upon the parent to make sure you've got the contact information, the phone number. You want to make sure you have either an ITIN or a social security number for the caregiver, certainly the address. And then it's the caregiver's responsibility to report their income on their return. There's a concept called whipsaw. And I saw this many times when I worked at the IRS. You'd have all these parents paying a caregiver to watch their kids. and then the caregiver wouldn't file their return. Well, the parents, that's not their concern. It's the caregiver's responsibility. So you want to capture that information. It's called a bona fide attempt to obtain information. And that means their social security number. So I'll use me as an example. So I dropped my kid off for the first time with my caregiver. I explained to the caregiver, I need your social security number. I've already got your address. I need your phone number. I need your full name, because I'm going to report this on my tax return because I'm eligible for the child independent care expense credit. And so that's what you want to do. And then, of course, again, it's a responsibility of the preparer to report their income. And then was that, who asked that question? Was that Tom?
Yeah.
Yeah. So does that make sense, Tom?
Yeah. It's just, you can't leave it with mom and put up a dollar amount that you gave your mother to write off the thing when they're not qualified per se.
Yeah, what I remember in some cases, you can do that, but at the end of the day, you want to make sure that you got all the information from the caregiver, and your caregiver should be licensed. I think that's the general rule. There may be some exceptions, but they want to be licensed. Okay, let's talk.
Just a weird story that I had on a VITA site. We had a situation where we had two siblings, and each of the siblings had children. And what they did was they had each of the sibling watch the kids for the other sibling. So they wanted to get the child dependent credit for paying the expense. And they also was picking up the earned income tax credit on the other side. So they were generating fictitious income and expenses to get both credits. So we told them we couldn't do it.
that's a really bad idea, because if you're trying to take a credit you're not entitled to, let's talk about the earned income tax credit. And what happens is, if you ever go to an examination, sometimes those taxpayers will be examined. Well, there's a 2-year prohibition for getting the credit, which means if you've made some mathematical errors, you've been careless, or if you engage in fraud, there's a 10-year prohibition. And what examiners do, they have these checklists. They go, down the checklist, and if the taxpayer can't substantiate something or they're not entitled to it, then the audit letter will go out. There will be essentially a recapture of the credit. And then now it starts getting really bad. And then the auditor will perhaps open up the previous year if the statute is still open. And in some cases, they'll open up 3 years. And I used to do this, and I'm not saying it was fun. It was just work. And we're talking many years ago, and taxpayers would walk out of the IRS office with a tax bill of $8,000 or $10,000. And so it becomes very expensive. And so what you want to do, you just want to do it right. If the taxpayer is trying to do something that's incorrect, say, we're not going to do that. That's not what we do in VITA. We prepare a return that's accurate, and we look up the rules if we're not sure of it. And you see that, John, that's a good point. You see it from time to time where taxpayers decide to, for lack of a better term, play games. And then if they do get audited, they get, now we're talking metaphorically now, they get punched in the face. They walk out with a huge tax bill. And for a moderate or low income taxpayer, that's a bad thing. Okay, work-related expenses. And so again, you're talking about someone dropping off typically their minor child, and they're going to work, they're looking for work, or in some cases, they're attending some type of college. And so you're paying expenses, and that's your out-of-pocket expenses. And then there's a limit to the expenses used to calculate the credit. So if you have 2 kids, then the limit per kid is $3,000. If you say, Jerry, will I pay $8,000 for each one of my kids? Okay, but the limit is $3,000 per kid, again, to calculate the credit. And yes, we know that when you pay some type of childcare expenses, you're at the end of the day, you're going to go and pick your kid up, and they're providing their service, they're watching the kid, they're feeding the kid, and all that good stuff. But again, it's a cost of daycare or childcare. And then when you're talking about kindergarten, and what I remember about kindergarten, it's usually, I think that's the before you go to first grade. And so kindergarten, that's not a work-related expenses. And so that's not going to count. And then this has been around for a long time. It says expenses for what is called before school care and after school care. And so that means your kids in school, maybe they're in first grade, you have to drop them off for daycare, and then you take them to first grade, and then after school care, for, let's say you're working until 7 or 8 o'clock at night. Those are also qualified expenses. And then here's another thing that's been around for a long time: your day camp, that's qualifying. But if you drop your kids off and they're in an overnight camp, those don't count. And so that would be your typical 2-week camp. You drop your kids off and they go to archery lessons, swimming, and all that. That's not going to be a qualified work-related expense. And the very bottom of the screen talks about custodial parents. And so that would be the person that has physical custody of a child, their child. And so you have to have physical custody of your child. That's a rule there for the child independent care expense credit. All right, Sean, I see a bunch of chats. Any questions?
No, I mean, some of it was the taxpayer income caps that we talked about, and Nancy Laming looked it up. The child tax credit phases out at $200,000 for single and $400,000 for married filing joint, which again is so high above the VITA limit.
Yeah, and those phase outs, there are so many different phase outs, and I certainly don't remember them. If I'm asked, then I'll look it up, but your software is going to cap all that out. And when someone asks about why am I not entitled to it, when you look at the tax return, then you can say, oh, well, you make X and you're not entitled to it, or you're not meeting one of these rules. Okay, here's the big credit. Big credit. I remember years ago, I used to talk about the mother of all credits, refundable credits. It used to be the adoption credit, and that was a monster, meaning a good monster, but that went away. It's non-refundable. And now, so this is the largest credit that I can think of on a federal return. And so when you're talking about the earned income tax credit, like any credit, you have to qualify. There's certain rules that you have to meet. And the EITC is a refundable credit, and that's typically what you see at the VITA site. And then also, when you prepare a federal and a state return, sometimes your clients are going to get the California EITC. Again, different rules for California and the federal government. And so if someone says, why didn't I get the California EITC? And the answer is, oh, that's easy. You didn't qualify for it. You had gross income or W-2 income of maybe $50,000, and that's well above the California limit. But you could get it for EITC if you meet all the other rules. And so let's run through these rules right here. So your summary of rules are on page I-4, India 4 in the publication 4012. Now what I'm going to do, Sean, I'm going to go ahead and see if I can bring up my publication 4012 and see if I can go to India 4. If I can find it. If I can, I'll have to do it after the break. No, I'll wait till after the break. So let me go back here. Okay, so the rules are on page India 4 in your publication 4012, and you have to meet all of these rules. So you have to have that earned income. So when you're talking about earned income, the software is going to take care of it for you based on W-2 wages, based on self-employment. And there is a limit. And so if you are working and your earned income is under that $63,398 amount, and you file a joint return, and you have 3 kids or more, then you may be eligible for a small amount of EITC. Think of that distribution curve you learned about in 8th or 9th grade. And so you've got people on the left-hand side, people on the right-hand side, and a lot of people in the middle. And so that distribution curve when you're talking about EITC, if you have a little bit of earned income and you meet all the other rules, you'll get a little bit of EITC. If you have a lot of income and you meet all the rules, you're going to get a little bit of EITC. And then that normal distribution curve in the middle, a lot of people are going to get the maximum EITC because perhaps maybe they've got earned income. And of course, AGI also figures in of maybe $20,000. And again, this is a very, very large credit. It's a refundable credit. And a lot of people come to the VITA site to get EITC. So you can get it with qualifying children or without. Again, you got to meet all the rules. And so for a qualifying child, they've got to be under 19. They got to be younger than you. And or if they're going to college, a full-time student, and they're under 24, then they could be considered a qualifying child. And when you're talking about a full-time student, the taxpayer is not going to determine full-time. It'll be the university or college that'll determine full-time. And I think I attended like 7 colleges. I don't know, I guess I bounced around, graduate school, undergraduate. Every college, they're like people, they're different. And so I went to a college, and if you were going 12 semester hours, you were considered full-time. Went to another college, if you go 9 semester hours, you're considered full-time. So you're going to have to reach out to the university to determine if you're full-time or not. And then if you have someone who's older, any age, and they're permanently disabled, then you may be eligible for the earned income tax credit. And then if you don't have any qualifying children, let's say you're a single person and you're low income, then you may be eligible, but you got to be at least 25 and under 65. This rule has changed. You might remember a couple of years ago, seniors over age 65 in some cases were eligible for EITC, but we're at 2023 tax year, and so that rule now is back into effect. And then here's another one you don't see a lot of, but when you do, you simply have to explain it to the taxpayer. Their investment income has to be below $11,000. And investment income is defined as interest income, tax exempt interest, dividend income, capital gains distribution, and capital gains. And so let's use an example. Let's say you've got someone comes to the VITA site and maybe they've got some earned income and they think they're eligible, but they've sold some stock and they've got a gain of, let's say, $12,000 on their stock. They held it for a number of years. That would make them ineligible for EITC, even though they've met most of the rules. You got to meet all the rules. When you hear the term capital gains distribution, the best way I can describe it is, let's say you are a shareholder in a mutual fund company. And then the mutual fund company, they invest in other corporations. And then when those corporations then report to the mutual fund company, they've sold assets. And or let me restate that, the mutual fund company has sold assets, then you have essentially a flow through down to the shareholder, i.e. the taxpayer. And that's called the capital gains distribution. Capital gains distributions are reported typically on a 1099 INT. And when you see the term capital gains distribution, that is a different animal than a capital gain. But again, the point is, if your investment income is below 11,000, you're okay. If it's above 11,000 and above, then you're ineligible for EITC. And then another one, you have to have a valid Social Security number. And that's typically not a bridge too far for most of our clients, our VITA clients. You've got to be a U.S. citizen or a resident alien. And then there's another rule. It says you can't file the form 2555. And the 2555, it deals with the foreign earned income exclusion. And so that's a question that pops up. Typically, our VITA clients, they're not going to file the 2555. But for those who do, that means they have typically worked and lived overseas, and they have earned income, and they want to exclude that on their tax return, which you can up to a certain limit. So again, this is something that we would ask them, but typically most taxpayers will say, no, I didn't live and work overseas. And then if you have separated from your spouse, and you're not filing a joint return, and these basically the new rules. If you remember the old rules from a few years ago, if you were filing a married filing separate return, that made you ineligible for EITC. Well, the rules have changed, and so page India 4 does a great job talking about those individuals filing separately. And then something that I've seen in the VITA program, I just saw this a couple of days ago. It's called the due diligence worksheet. If you are a tax professional, you have to fill out the due diligence worksheet when you take certain credits. And for the VITA taxpayer, for the VITA volunteer, we don't fill out the due diligence worksheet. That essentially is stripped away from the product that we use, because our product that we use, i.e. our software, is slightly different than tax professional software, i.e. the TaxSlayer Pro, because TaxSlayer is hired. There's a contract between the federal government and TaxSlayer, and they make that product that we use in the VITA program a little bit different than the software that professionals use. So again, these are the basic rules, and it's incumbent upon the VITA volunteer to make sure you get that valid Social Security number, and all of these rules are met. And sometimes taxpayers say, why am I not getting EITC? And you can say, well, you don't meet all the rules, and you can show them India 4 from publication 4012, or that EITC publication that we talked about. But typically, a lot of people come to the VITA site because they are entitled to it, and they are their AGI and their earned income is below a certain amount. Okay, any questions about EITC? Let me see if we got a second page now.
Yeah, Jerry, there's a question.
Okay.
The last bullet talks about married filing separately, and just clarifying that we don't serve people who are married because it's outside of scope.
That's correct. That is correct. If they say, and we see this all the time, hey, can you just make an exception? And the answer is no, we're not trained to do this. Because if you know anything about filing a separate return, it depends on a number of factors. And again, we're not trained to do it outside of the scope. So just refer them out in town. And again, when people ask me, where should I go? I say, hey, go to a website of a tax society, the Enrolled Agent Society of California or Orange County, the California Society of Tax Consultants. There's a CPA society, and just refer them out to one of these societies where they can look up a professional. And then, of course, it'll beg the question, hey, what do they charge? And I always tell them, I don't know. They're going to charge what they can charge, and we can't help you here. So you got to go. You got some options. You can do it yourself. You can have your friend help you out, or you can go to a professional tax preparer. And if you do go to a professional tax preparer and they're worth their salt, they are going to be able to help out someone who wants to file separately.
And then there's a question: if somebody's separated, can the person with dependent children file as head of household and still meet VITA?
Let's see. Now, when you say separated, there's different types of separation. You have geographic separation, you have legal separation.
I'm not the one asking the question. I'm just reading it out of the chat.
Yes, I think the answer is
Right.
yes,
Then-
but you have to interview. You have to interview to get the right. What is separated? Outside the house for the last 6 months. In fact, this is a
Yeah.
question that's on the advanced exam.
Yeah, that's a good point. So when you're talking about someone says, hey, I'm separated, okay, so give me more information. If the spouse has left the house and they're outside of the house for the last 6 months, what that means is if the tax return meets all the other rules for head of household filing status, they can get that, because head of household filing status says you must be unmarried or you must be considered unmarried. So I'll give you an example. So let's say you've got a married couple, everything's going great. And in March of a particular year, let's say 2023, the husband announces to the wife, I'm out of here. Husband takes off, packs his bags, and leaves. He doesn't contact his spouse from March all the way through December. and there's no contact. He's out of the house. And so if the wife then, if she meets all the other rules and she's got some dependents, she can claim the head of household filing status because she's considered unmarried. And if you're new, you're thinking, what do you mean considered unmarried? These are tax rules, and that's one of the tax rules, considered unmarried, even though you're still legally married. So yeah, that's a point there.
And then another question had to do with the foreign earned income. Was that always out of scope for VITA program, or is it just out of scope for earned income tax credit?
The foreign earned income is out of scope for basic filers. Let me restate that, for the basic module and the advanced module. If you complete the international module, the 2555 is in scope, and we will help people out. But for St. Killian's VITA, we're not going to do the 2555. But you got to ask the question. So that means, hey, did you file the 2555?
Yeah, we had one client with that 3 years ago, and I don't think I ever want to do that again. It was really complicated because their income was from China and everything was hard to read.
Yeah, and even if you're certified at that particular thing, you're right. The 2555 can be easy breezy, or it can be a challenge. I had a paying client who had a 2555, and that's exactly what we had to do. I had to determine all of the income he earned. We had to do a conversion from whatever, I think it's the yuan in China. He was working in China. We had to do the conversion. So the 2555 can get involved. But again, we don't do this at the St. Killian's VITA site. Okay. Sean, I've got 11:06. This is a great time to take a break.
Yes, it is.
So we'll take 10.
All right, recording paused.
Sean, we'll get started in 2 minutes.
Okay, Jerry.
All right, Sean, we'll get started.
Okay, Jerry, recording's on.
Okay, we're back and we're going to talk about the education credits. This is something that we see at the VITA site a lot. And at the site that I teach at, Garden Grove, Hillside College, we have a lot of students. And so the two benefits that you're going to be bumping into, or the two credits, would be the American Opportunity Tax Credit, which has both a refundable and non-refundable component, and then the Lifetime Learning Credit. And we're going to show you in publication 4012 the differences between these two particular credits. But again, the American Opportunity Credit, think of generally your students that are going to undergraduate. That's the general rule. And so if they are going to undergraduate, and of course they qualify for this credit, then they can be entitled to both the refundable and non-refundable component. And one thing about the credits that we speak of, you're thinking of out-of-pocket expenses. And if you are receiving, for example, a scholarship, let's say your scholarship is $9,000 and your tuition is $9,000, you don't have any out-of-pocket expenses. And so this is something, when you're talking about the credits, you have to determine if the individual received any type of scholarships or grants. And of course, you have to account for those, because at the end of the day, you're looking at out-of-pocket expenses. Now, some people, and I did this too when I went to college, some people borrow money to pay tuition. When you borrow money, you essentially take title to the money. It's your money. Of course, you have to pay it back. And so that means if you're borrowing money to pay tuition, then you still have out-of-pocket expenses. And if you meet all the other rules, then you're entitled to one of these credits. So again, American Opportunity, typically undergraduate, lifetime learning. This is everybody on the return for lifetime learning, mom, dad, and any kids. And the limit is $2,000 for the credit. And that is a non-refundable credit as opposed to the American Opportunity credit. And if you have the same student, you can't get both of these credits as one or the other. And most individuals will select the American Opportunity tax credit because, again, it has a refundable component.
Hey, Jerry, there was a question that came in during the break.
Okay.
A number of times you've talked about referring people to a place if they have more complicated tax issues that we can't help them. What was the website, or where would people find that list?
You'd go to Google and you'd Google the California Society of Tax Consultants, or you go to Google and you'd Google the Enrolled Agent Society of Orange County, or you'd go to Google and you'd Google the California CPA website, and it'll give you a list of tax CPAs. There are some certified public accountants who are not in tax, and so you'd go to one who specializes in tax.
Okay, thank you.
Sure. Okay, so AOC, this is the general rule. Think of undergraduate students. Now, when you get into the details, you may have a graduate student who is eligible for the American Opportunity Tax Credit. And that means they haven't completed their first 4 years before the beginning of the tax year. But typically, I think I've seen that one time in the many, many years that I've done VITA. And so typically you're looking at undergraduates. And you can only claim this for 4 tax years. So that's one of the questions. And if the person is maybe in their late 30s, early 40s, and they're in college, maybe they took the HOPE scholarship credit many years ago, and that's one of those years. They can only do it for 4 tax years. They have to be enrolled half time. They have to be in a degree program, and the university or college is going to determine what is considered at least half time. And then this is one of those social engineering components, and I guess it depends on your point of view. No felony drug convictions, and they can't have completed the first 4 years of their college before the end of the year. So these are some of the rules. And again, your takeaway would be your out-of-pocket expenses. And then what happens is your student will be issued an IRS form 1098 T as in Tango. And that document is going to show the amount of tuition that's been billed, any scholarships that the student was entitled to. And again, you're looking at out-of-pocket expenses. In the publication 4012, it does an excellent job going through what is called the calculation of qualified educational expenses. And then, as we've talked about earlier, for some of the other items, there are phase-outs. We don't concern ourselves with the phase-out because in the VITA program, typically we're looking at taxpayers with about $64,000 or less. And then your LLC, and no, that's not limited liability company. That's the lifetime learning credit. And this is for anybody who's going to college or university to acquire or improve job skills. That's pretty broad. And so what that means is you're going to school, maybe you're taking a part-time course. So I'll use me as an example. Years ago, I decided I wanted to take some real estate courses to get smart on real estate. And so I took a course here and a course there, and I already graduated from college. And so in that particular case, if I met all the rules, I could go ahead and take the lifetime learning credit. But again, it's for everybody on the return, and the maximum is $2,000. And yes, there are phase outs. And again, they're above the VITA limits. So let me do this. Let me go ahead and pause and jump into our 4012 and show you a
Hey, Jerry, can I ask you a question on the American
Sure.
Opportunity Credit? Is it possible for you, and I don't know if this is going to come up later, if you have a dependent and your dependent is the one going to school, can the parent use that credit?
Sure. In fact, you're going to see that a lot where the mom or dad will have an adult son or daughter, and if they meet all the rules, then the mom or dad on their return will be able to take one of the credits.
Thanks. We have that one that comes up a lot in the deciding where should it go, who should take the credit, and that sort of thing.
And so this comparison, and let me see if I can get the page. This is Julia 8. And Sean, can you see where it says comparison of education credits?
Yeah, sure. We can see that. Jerry, there's a quick question. Do vocational schools qualify for this credit?
The short answer is if you're attending a vocational school and that particular school participates in the United States Department of Education grant and loan program, then it would be qualified. So for example, a couple blocks from my house, there's a real estate school, and people go there to learn about real estate, to become either a real estate agent or a broker. They pay X number of dollars, and then that real estate school, of course, it's licensed by the state of California, but it does not participate in any grant or loan program through the U.S. Department of Education. So that's a non-qualified school. And so another example may be, and I don't know all the rules for cosmetology, and that would be where individuals go to learn about nails, they learn about skin, I guess, they learn about hair, and then they are a cosmetologist. Chances are that school doesn't participate in the loan or grant program, so that would be a non-qualifying educational institution. And so let me focus on a couple things. We know about the phase out. We're not concerned about that because well beyond the dollar amount for VITA. But here are your comparisons on Julia 8. Does a really good job. And I want to focus in on a couple things. The first one I want to focus in on is publication 970. That's an IRS publication. Does a great job describing various credits to include these two. And then where it talks about the qualified expenses, also known as qualified educational expenses. So this does require some follow-up questions of the taxpayers. Typically, they'll give you the IRS form 1098 T as in Tango, and that 1098 T as in Tango will not show information regarding textbooks that are rented or purchased. And if someone is purchasing textbooks or renting textbooks, then that's part of the qualified educational expenses. And so you have to go through a computation to determine out-of-pocket expenses, which may include textbooks. And so you want to include that as far as your qualified expenses when you plug it into the software. And then a couple other things when you're talking about American Opportunity Credit, they've got to be in some type of program. And so that program, let's say you're enrolling in the University of California in Irvine in the electrical engineering program, and then you're going more than half time, you've got out-of-pocket expenses, you meet all the rules, and that's an example of the American Opportunity Tax Credit. Your lifetime learning, again, it's similar, but there are differences. The entire amount is non-refundable. You're going to school part-time, maybe a course here and a course there. It doesn't mean you're in some type of, you haven't matriculated in some type of program. And then similar to the American Opportunity Credit, you've got out-of-pocket expenses for tuition and you got enrollment fees. And then, of course, you have to, again, determine qualified expenses. And I think this page would probably help you out. There are many other pages in the 4012, but again, this is the page I think to kind of give you the comparison. And most people will take the American Opportunity Credit because it's the greater of. It has that 2,500, and again, a refundable and a non-refundable component. All right, any questions about that, Sean?
I do not see any more questions.
Okay. Let me go back to my presentation and open that up. And so again, just asking those probing questions, and you just got to ask the question and get the answer. And it's okay if someone says, I don't know. They can come back the next week. You can do what you can. They come back with a document, and that's okay.
Okay, Jerry, here's a question. It's a little bit of a curveball. What if someone was convicted of a felony drug offense and later the charge was dismissed?
Well, I'm not an attorney. They threw me out of law school after my first year. But if you've been convicted of an offense, then typically what happens is that's on your record. When you say dismissed, that means you go back into court and a judge then expunges it or finds you not guilty. So that means because there's new evidence. And so in that case, I would say that if there's new evidence, then you're not going to be a convicted felon, because what happens is the judge says new evidence. I'm taking that into consideration, and I'm going to release you from jail, and whatever the legal term is, finding not guilty. Usually you don't see that. That's pretty rare. But if it does happen, again, get the story from the taxpayer, and then, like they say in Hollywood, storyboard it and see at the end of the day, what do you have? Do you have someone who has a current conviction or a conviction that has been overturned? I think that's the term they use in the legal world.
I guess you could do an amended return as well, potentially.
You could, and I recognize there's all sorts of things, but bumping into that, I don't think you're going to see that at VITA. But
Yeah.
but when I bump into something that's different, I ask people, tell me the story. I start taking notes, and if you remember that intake and interview sheet, you go to the page where you've got all those empty lines. You can go ahead and you can make notes when they tell you the story, and that's okay. They tell you the story, and then you make that determination based on your 4012. Okay. A couple other things, you're going to see some of this from time to time. We already know about self-employment tax, and that's going to be on that Schedule C as in Charlie, computed on the Schedule SE, Sierra Echo. And some of your young adults, and I'm not making fun of young adults. I was a young adult one time, and I didn't know a lot of stuff. In fact, I'm an old adult now, and I still don't know a lot of stuff. But anyway, Self-Employment Contributions Act, this passed in the 50s. And so the vast majority of self-employed individuals, they have to pay self-employment tax automatically calculated at our VITA site. That's typically what we're going to see. And this is essentially the equivalent of FICA, the Federal Insurance Contributions Act. So when people are making contributions and that's the term they use, it's really a tax. That's what the Supreme Court decided years ago. So when you're making contributions, what that means is you may be eligible for Social Security once you reach a certain age if you have enough qualifying quarters. But again, that's something for self-employment people. I threw in notary income because sometimes you'll bump into a notary. And what I remember about notaries, they notarize documents. They have to report their income, but they don't pay self-employment tax. And then the discussion regarding unreported tips.
Hey, Jerry, before you get into that new topic, there was a long question that somebody was typing about student scholarships and expenses. In the example, if a student had more scholarship than their actual expenses, how would we treat that to minimize the tax burden on if the child's still a dependent? Can we make them? file
There's a couple
separate
ways
tax
you can
return?
do it. Yeah, the general rule is you're going to determine out-of-pocket expenses. In some cases, you can do this. We've done this before. You can report the entire scholarship as a taxable event, and then on or in the software, you can go ahead and report that the individual had simply out-of-pocket expenses because they reported the scholarship as a taxable event. But what I remember when you're talking about scholarships, and there are many different types, if they exceed your tuition, and then what I remember, I think the general rule is you can report that as a taxable event, but the Pub 4012 talks about the scholarships. And the publication 970 has a lot of examples regarding scholarships. But I think the takeaway is you're typically going to bump into your out-of-pocket expenses. What are the out-of-pocket expenses? And you have to account for scholarships that the individual received.
Jerry, I think Adela's question is got more of a spin on it, right? If you've got a situation where you've got a dependent, and what she's saying is, and suppose you do have the scholarship that exceeds the amount of expenses, can you allocate the scholarship income to the student? And maybe they're in a zero tax bracket, and then you allocate the expenses to the parent for which they can, use those expenses for the credits.
Yeah, I'm not going to take a stab at that. That requires a higher
Okay.
level of thinking. And so what
Okay.
we can do is, in fact, what I'll do, I'll jot that down. And then next time we meet, we'll go ahead and dig into
Okay.
Scholarships and expenses. Because if I
Okay.
give you an answer, it's probably wrong.
Okay. I mean, just Adela's got the question. If you want to just jot,
Mhm.
it's in the chat.
Yeah, there's different ways to do it, but yeah,
Yep.
let me dig into that. Okay, so for tips, this is the important thing. Again, we're not auditors, but sometimes you're going to have someone who receives tip income. And here's the rule. If you receive $1 in tip income in 2023, that's going to be reported on your tax return because that's considered part of gross income. And you have to pay FICA, which is the Federal Insurance Contributions Act, on unreported tips. And so you got to do that. Most people report it to their employer, but at the end of the day, you've got to report the income and you've got to pay FICA on your tips if you don't report it to the employer. The IRS form 4137, it will tax the unreported tips. And so you got to remember that. And then I'll kind of focus on what I do. Again, yes, I do have the background as a revenue agent, as a tax practitioner. I understand that. But I bump into people in the VITA site and I'm looking at the things and thinking, wait a second, this doesn't make any sense. So the example is you got someone who pays living expenses of 40K, their income's 25. And well, the delta there is 15,000 and there's no unreported income. And so I look at the tax return and say, you know something, this doesn't make any sense to me. And then typically the response I get from taxpayers, Jerry, it's not easy. And I look at them and said, you know something, I'm a trained accountant. This is mathematically impossible. And so I'm not going to do your return. I don't feel comfortable doing your return because this doesn't make any sense. And I tell them, I'm not going to prepare your return. I'm the site coordinator. I get involved and I say, you're going to have to explain this. And they go, well, it's not easy. Nope, we're not going to do your return. Again, we're not auditors, but you don't want to set someone else. Let me restate that. Set someone up for difficulty. And you have to avoid these type of returns. And I've seen these time and time again. People just kind of stare at me and say, well, Jerry, it's really tough living in Orange County. I'm thinking, no, there's something else involved here. Either you have fewer living expenses or you have more income, and chances are you have more income. And so we're here to prepare your return. Tell us about your taxable income. And again, I see this all the time, and I just sit down with people and I tell them, this is my training, and we're not going to let this return go out the door. Now, Sean, I'm not sure how you're going to do it, but that's my recommendation.
Yeah, no, Jerry, I've run into the same thing. We had a client that was Social Security income $25,000 and had also purchased a $2.5 million house with a $800,000 mortgage, and it just didn't even close, not even close to adding up.
Yeah, and if you ever go to an IRS auditor, revenue agent or tax compliance officer who's been there for a few years, they're simply going to do that indirect income methodology, and then the taxpayer most likely walks out with a very large tax bill. Okay, so enough about that. Tax and early distribution. This happens all the time. This may not be the most ideal thing for a taxpayer, but at the end of the day, people either want to take an early distribution, or in some cases they have to. The money's there and maybe they need the money. Well, here's the rule, the general rule, and you'll hear me talk about this all the time. There's a general rule. For example, wages, W-2 wages, the general rule is you report it on your tax return. There's exceptions to that. In some cases, some individuals who receive W-2 wages do not report any of those wages on their tax return. So again, you have to look for exceptions, but we stick with the general rule typically. So when you take an early distribution from your 401k, let's say, or your IRA, the general rule is there's a 10% penalty federal and a 2.5% penalty. And then, of course, you have to pay income tax on that distribution if it's all tax deferred. So this is very expensive money if you've ever taken a distribution from your 401k as a younger adult. And so the general rule is if you're under 59.5 and you take that distribution, you're going to be stuck with these penalties. Now, there are a number of exceptions, and those exceptions include disability, medical expenses. You take the distribution to pay medical expenses. You take the distribution to pay for college. You take the distribution to purchase your home. And so when people take that early distribution, what you want to do, you want to determine, is there an exception? And if you go to page Hotel 7 in publication 4012, that'll be the laundry list of the exceptions. And then again, ask those probing questions. And then sometimes you're going to have to go through a calculation. But again, this is something we see a lot of. I have seen this so many times, it's like a broken record. I've actually had clients call me up, say, Jerry, I'm thinking about taking a distribution. What do you think? I'm thinking, well, do what you need to do. But here are the tax consequences. Again, 10%, 2.5%, and then you pay income tax on the distribution. So if you do the quick math, you're talking 30, 40, 45% in some cases. And so at the end of the day, a lot of money goes out to income taxes and penalties.
So a couple of questions popped up on this one, Jerry. The first one is if they take a loan on their 401k, is there any tax issue?
No, and that's a good point. When you borrow money, whether you borrow money for college, a television set, motorcycle, house, there are no tax consequences to borrowing money. None. You can borrow away if the bank wants to lend you money. When you don't pay money back, then there could be tax consequences.
And then on unreportable tax income, if somebody has a garage sale, do they have to pay income and sales tax on the things they sell?
Yeah, when you have a garage sale, and let's say in the garage sale, you're selling your what the accountants call tangible personal property, i.e. an old microwave, an old television, a bunch of dishes, old dishes that you own. You retain title to those items. And so what happens is you're actually selling capital assets. And when you go through the calculation, let's say you buy those dishes for $500 and now you're selling them for $25. You have disposition of a capital asset, and that disposition includes a capital loss, which is non-deductible. So the bottom line is most garage sales, there's no tax consequence. Okay. Is that pretty much it, Sean?
Yeah, I guess I would just clarify, like,
So he's
it's
about sales
possible
tax,
if we, oh yeah, how about sales taxes? That's kind of out of our scope, huh?
Sales tax is out of scope. Sales tax is paid to the California Department of Tax and Fee Administration. My understanding is, I think I've had a couple of garage sales. I've talked to a couple hundred people, and I've never heard of anybody charging sales tax for their personal assets or their capital assets they're selling to others.
Yeah,
Well,
and on a
and then-
garage sale, like we might get clients who roam around the neighborhood and pick up other people's stuff and then sell it. And then in that case, there might be a tax consequence, but they're probably not going to tell you.
They have to be a licensed retailer before they can charge sales tax.
Yeah, I've never seen that for a garage sale. And here's another thing: if you're picking up items from other people, what that means is they're either giving you these items or you're purchasing those items, which means now you retain title, which now it means you've got a capital asset when you resell it. Okay, this is something I think we talked about last year, and you may hear the term step up in basis. So what that means is, and probably the best example I can give you is you've got a son, an adult son who inherits stock when his father passes. And in this example, you've got the stock cost the dad way back in the day 16K, and then the fair market value at the date of death is 96,000. And so the son's basis in the stock is 96,000. When you sell a capital asset, you have to determine your basis or adjusted basis. You've got your proceeds and then your basis or adjusted basis. Typically, what you're going to see an IRS form 1099-B as in Bravo, and that'll list all of the capital assets that are sold by the taxpayer, i.e. stock. And then your 1099-B will differentiate between short and long term. And probably the takeaway here is you may see this from time to time. And then what I do with 1099-Bs, when they're very lengthy, I tell the taxpayer, I'm going to aggregate, I'm going to add up all your short term, I'm going to add up all your long term, and it's going to be a one-line entry. I'm not going to sit there or have one of my guys or gals sit there and type away for 3 hours. It's not going to happen. And I do that in my practice too. I tell my clients, if you want me to type away and indicate each and every transaction, I'm going to charge you a lot of money. And most of my clients say, okay, Jerry, just aggregate.
Jerry,
We have a guy on the call here, and I forget his name, but chime in if you can help out here. So people receive life insurance payments, and there's different types of life insurance. Typically, I think they're divided into two categories: term life insurance, which is cheaper. You're going to get a lot of coverage, and then what happens is you pass, and your beneficiaries receive a check, and that's a non-taxable event. And then there's other terms. I know it's known as universal, whole life. There's probably 2 or 3 other terms, but whole life typically has a cash value. And when you surrender a policy, as it says on the screen, there may be a taxable event. And your starting point would be that information return, the 1099-R. And then you got to dig into the 4012. Any comments regarding, like I say, I think we have a financial guy regarding life insurance.
That's me, Clayton. Right. Yes. All death benefits are tax-free. If you receive early benefits, you'll get that 1099. If you receive early benefits like an accelerated benefit rider, that's going to be tax-free. If you sell your policy to somebody else as a viatical settlement, your proceeds will be tax-free, but when it's upon death, the person that purchased the policy from you will pay taxes above their cost basis. And then that last line right there, the surrender of the policy. If you surrender the policy, it kind of really depends. You pay taxes upon anything above your cost basis in a cash value policy. Whole life is a form of cash value policy. There are several forms. So I just call it a cash value policy. Thinking about it like a home, you build equity in it. And that gets a little complicated. It depends upon how the actual surrender is done. If there is a taxable event on that policy, you'll get that 1099-R, and that'll illustrate how much is the tax on that.
Good summary. And then, so what I do is when people say I received a life insurance payment, I ask a number of questions. I jump in the 4012 to determine if it's within scope. And if it is, then we can figure that out. But good point. And who was that again? That was Clayton?
Yeah. And think about it like this: 99 out of 100% of the time when somebody receives a life insurance benefit payment, it's going to be tax-free. The rare occasions that we'll see where there's a taxable event on that will probably be well outside of our scope.
Okay, very good. Thank you, Clayton. And yeah, we got to put you to work at the VITA site. You can be our life insurance expert.
Happy to do so. That's why I'm here.
All right. And we did see, I think last year at St. Killian's, we saw at least one individual that had a whole life policy and surrendered it. So so you may see that from time to time.
Hey, Jerry, can I mention
Okay,
something?
sure.
On the previous slide, you were talking about step up in basis, and just so people are clear, it doesn't just apply to capital gains on stocks, but a common thing is when a couple owns a home in joint ownership, and then one half of the couple passes away, then there could be a step up in basis for the surviving spouse.
There
Yeah,
will be.
when when you're talking about a home, then what happens is you can own your home, and there's no tax consequences to owning your home as far as disposition. But once you sell your personal residence is a capital asset, then you have to account for adjusted basis. And there's a couple other things you want to look at. You want to look at the settlement statements if you went through escrow, which chances are you did. And that's not a bridge too far to calculate capital gain, but you do have to have settlement statements buying and selling.
Step up, again, that's another part of my expertise. On a property, we're a California community property state, so one spouse passes. You want to tell that individual that comes to us, make sure you get your home appraised. And whatever that appraisal value is, that fair market value on that appraisal date is the new value of the property for the surviving spouse. In other states, which is out of our scope, it's a little different, so I won't get into that.
You know, that's a good point. There are many different gold standards, and one gold standard to determine the value of real estate is an appraiser who's licensed and certified and giving you an opinion. That's a gold standard. Okay, so let's talk about Gene, and then we'll jump into the software if it's operational. And so Gene is finally head of household. There's her administrative data. And we've got a daughter. Jean's daughter is about 3 years old and change. And the daughter's a U.S. citizen and has lived with Jean for 12 months in 2022. We're going to look at the 2022 software. Try to do this with 2023 when the system was working, bumped into a couple issues. So we're just going to revert back to 2022. Okay, so she is a wage earner, and she works for that corporation, the Piggly Wiggle, and she got $30,000 of W-2 income. FTW is an acronym for federal tax withheld. Typically, that's what you're going to see with wage earners. They're typically going to have tax withheld. And then, of course, not everybody, but a lot of people in California pay state disability insurance. And she paid $150. She has state tax withheld. That's withheld by the employer, remitted to the state of California. That's $700. And then she had health insurance paid by her employer on behalf of her, and that's code Delta Delta 4600. She also went to higher education. She got the 1098T as in Tango, and that's the address of the university, and she attended less than half time. So that's a trigger for me, telling me that she may be entitled to the lifetime learning credit, and she paid out of pocket $1,000. And then her daughter, she drops the daughter off to go to work, and daughter is Maria, and drops him off at toddler time. And there's the administrative data for toddler time. And the reason she drops off the daughter is to go to work. I did see this a couple times where taxpayers actually admitted to me. They said, Jerry, I dropped my kid off. And what I do is I go out and I goof off with my friends, or I go and take a trip and do this. Well, that doesn't count. You have to drop your kid off. So you're going to work, or you're looking for work, or in some cases, you're attending school. But if you're dropping your kid off to go out and enjoy some time off, that doesn't count. And then she also performed jury duty. And in this particular case, and you see this from time to time, jury duty is a very modest pay. I think the last time I looked, it was 15 or 20 bucks a day. And a lot of people, when they go on jury duty, they continue to receive their full-time pay from their employer. So when I was a jury duty guy, I worked for the federal government. Come back with my jury duty check and I remitted it or gave it to my IRS secretary, which means step number one, I have to report jury duty. Step number two, then I could take what is called an adjustment to income for that jury duty pay that I remitted to my employer. And so you want to make sure if there's jury duty, you want to ask them, hey, did you hand over your check to your employer? And if not, then you just go to step number one, report jury duty pay. Okay, and so I'll leave this up for a couple minutes to let it settle in your brain. And then what we're going to do, we're going to open up the software if it works, and we are going to run through this return for tax year 2022. Any questions about the fact pattern? Scott, anything in the chat?
There's nothing in the chat.
Okay. All right, so we'll leave that up for a few minutes.
Got a question in the chat.
Okay.
So the question was, if your jury duty pay includes mileage that you do not repay to your employer, is that declared as income?
When you have mileage and you're reimbursed for that mileage by the court, that is a non-taxable event. Okay. So Sean, what I'm going to do is we're going to take in fact, this might be time for probably a short, let's take a short break, and then that way we can spend the rest of the time navigating through the software. But before we do, let me go ahead and show the crowd here this information. So for session number 4, scheduled for the 9th of December, which is next Saturday, and we're going to talk about a number of topics to include preparation of a tax return for California. I'll do 2023 if it pops up on the practice lab. Otherwise, we'll default to 2022. We'll talk about the California CA form, the Schedule CA. And then we'll talk about the various California non-refundable and refundable credits. And that also includes the renter's credit. It also includes California earned income tax credit and the young child tax credit. And then we'll jump through an example which includes someone who is covered under the Affordable Care Act, and in California we call that Covered California. So it'll be a mostly California focused or centric, if you will. Of course, we will prepare a federal return at the same time. And I think that's it. So what I'll do now, Sean, is let's take I've got 11:56. Yeah, let's take 10 minutes and we'll come back at 12:06 and jump through the software.
Okay. And there was one question, I'm answering it right now in the chat, about can you get a credit for courses taken to acquire or improve job skills? And that would be the lifetime learning credit if you meet all the
Lifetime
other.
learning credit. Yeah, that's true. Acquire or improve.
All right. I'm pausing the recording.
Okay. And then Sean, can you see the screen that says basic information?
Yes, sir. We see that.
Okay, great.
During the break, the lady in the chat clarified that she was asking about if in your example for Gene Arista, was that class taken to acquire or improve job skills?
The answer would be yes. Because really anytime you, and that's a pretty liberal definition, anytime you take a class, you're either acquiring new skills or you're improving your skills. So I'm a tax guy. So if I take a class at my local college on floral design, I'm acquiring a new skill. All right, we're going to go ahead and get started. Okay, so change one, I do have the 2023 software up for the practice lab. So we're going to focus on 2023. So my example is everything for 2023. And just a quick reminder, when you are preparing returns, make sure you're in the right year. I've only done this probably 100 times where I open up the software, I'm preparing to return, I realize, whoops, wrong tax year. And so I always start in the upper left-hand corner to make sure that I'm in the right tax year. So we're going to stick with 2023. All right, I'm on the software right now. If you haven't played with the practice lab as of yet, chances are you want to get into it. You got to register. And then I use the term navigating through it. And that way you have familiarity with the software. And then when you're ready to take the certifications, you will have to prepare tax returns. And then you'll take certain answers off the tax return and plug it into the Lincoln Learn test that you're going to be taking. Although I do recommend start with the form 6744. So let's go to filing status. And again, we're in tax year 2023. And you can see the taxpayer is Jean Arista. And so your filing statuses are generally going to be single, married filing, joint, head of household, or qualifying surviving spouse. That's typically what you're going to see at the VITA site. We don't do married filing separate. So we're going to start with head of household. She meets the rules. She is unmarried. We're talking Jean now. And she has a minor child at home, and she cares for the child. She pays for the upkeep of her home. And so she's entitled to that head of household filing status. We're going to go ahead and hit continue. Usually a name is not an issue. Sometimes at the VITA site, people will give me a moniker, or they'll give me an abbreviation. And so I tell them, I need to look at your social security card, and we're going to use the name on the social security card. Sometimes you'll have transposition errors, and those transposition errors with the name will result in a rejected return. And again, you've got to make sure you perfect that. Typically, that's going to be done by the ERO, the electronic return originator. Social security numbers, usually right from the social security card, not an issue. Date of birth, typically not an issue. Over here, usually these boxes right here, the ones that you're going to spend time with, you have a taxpayer who can be claimed as a dependent, or they're over 18 and going to school, or maybe they're blind according to the tax definition, or you might have a taxpayer that's deceased and mom and dad are coming in, typically for an adult child, and then filing a return for that final refund that's coming out to in this case the parents. Sometimes the taxpayer wants to contribute monies to the presidential election campaign fund. Really, this is an order to the federal government. It doesn't affect their refund or amount that they owe. We don't do military at the St. Killian's VITA site, so we don't worry about the combat zone or the qualified hazardous duty area. If you're at my site in Garden Grove, we do attend to military taxpayers, and sometimes that pops up. Other things, a lot of people have digital assets, cryptocurrency in the VITA program. If you buy cryptocurrency, we can help you out. If you sell cryptocurrency, which is considered a capital asset, we will not prepare your return. And then down here, a lot of taxpayers, like for me as an example, English is not my first language. And so if I wanted written communications in my first language, I would check here. And then the IRS would send you notices if they need to send you notices in your native tongue. Address, most people will use their residential street address. And then again, we only prepare California returns and federal returns, so we'll indicate that. And then you want to capture the contact information in case we need to perfect the return. Usually you'll get both the phone number and the email address for the taxpayer. And then for dependents, we'll open that up. And in this case, we've got one dependent. If you've got multiple dependents, then you simply go to add a dependent or a qualifying child. So we'll open this up.
Is there any way where we can expand the font a little bit?
Extend the font.
Oh, make it a little bit bigger.
Let's see.
Control plus, yeah, there we go. Now I can see it. Thank you.
Sure, sure. Okay, so we have our child, Maria, and she's a little kid. Let's see. I think we had her born in 2019. So there we go, on the fly change. Okay, so she's 3 years old and change. Most of the time, you're going to have a social security number, and that'll come off that social security card. And that's why this is kind of non-negotiable. People come in and they go, well, I don't have my card with me. The general rule is we want to take a look at their card, and that's on a piece of paper or an electronic device. And then in this case, this little kid is a U.S. citizen. That's typically what you're going to see. If they're a resident alien, that means they've gone through immigration and they've got a resident alien card. Okay, she's a daughter, and you can see the laundry list goes all the way down to lineal descendants. And then she's in the home, 12 months, she's a little kid. And then for dependents, typically what you're going to see, you may see a young adult who's over 18 going to school. And if that's the case, you would check this box. All right, so we've got the child entered in there. And you can see the dashboard. And the dashboard, again, shows that dependent. And if you have to add another one, you'll add another one. Over here, if you remember that red garbage can, if you've garbled the entry sufficiently, you want it to go away, then you'd hit that red garbage can. And then this entry that we have here in the dashboard will go away. If you need to make changes, that's that blue pencil. And I will have to go back and forth on the size of the font, so forgive me. All right, so we're done there with the dependent. And we're going to go to our income slide, and we go to W-2. If you have multiple W-2s, which you may see in the VITA program, you simply add the W-2 up here where it says add W-2. We're going to open that up. And generally, we have a standard W-2. Sometimes to correct the W-2, the story I love telling, when I worked for the IRS, I was issued a W-2. It was incorrect. I went to the payroll folks. I said, hey, it's incorrect. And they corrected it and gave me an amended or a corrected W-2. Sometimes you have individuals who have a year-end pay statement, pay stub, and it has all that cumulative information. And if that's the case, we can prepare a substitute W-2. Sometimes individuals do not get issued a W-2, or they lose their W-2, and for some reason they can't get a reissuance. So you might have a substitute W-2, but you have to have year-end cumulative information. The information regarding the W-2, the mantra is we're going to key it as we see it. In this case, we have an EIN, an employer identification number. And this, what happens a lot of times, we'll have transposition errors. Numbers will be swapped around. So that's why we do have that quality review, at least one reason for quality review. We've got the name of the employer. And in this case, the employer is based in California. So we've got all of that data that we've entered. We got the information that rolls over for Gene. And so we got that data. And then here in box 1 for the W-2, again, we keyed as we see it from the W-2. And last year, I recall probably a half a dozen taxpayers showing me a W-2 on some type of electronic device. That's acceptable. One thing that I absolutely refuse to do when someone comes in with a piece of paper and they've scribbled or transcribed all that information from a W-2 onto a piece of paper, I tell them I need a piece of paper that has a W-2 on it, or I need an electronic device that displays a W-2. And Sean, I'm not sure how you're going to work it, but that's how I fly.
No, that's the same way we do it.
Okay. All right. So wages, a 30,000 federal income tax withheld. Typically, you're going to see that. Sometimes taxpayers are going to qualify for no tax withheld, but typically you see tax withheld. Once you enter that into the software, it'll roll over to page 2 of the Form 1040. And then your Social Security wages, not everybody pays Social Security. Like, for example, I teach part-time at a few colleges, and I've never paid a penny in Social Security wages to the colleges. So sometimes that'll be blank. But again, for our taxpayer, it's going to be reflected. And when you see the 30,000 in box 1, 3, and 5, that tells me there's no contributions to a tax-deferred savings plan like a 401k. Your Social Security, like I mentioned, a lot of people pay into Social Security, but not everybody. And in this case, she does, which is 6.2% of her gross wages. And then her Medicare is 1.45%. That's auto-populated. And if for some strange reason, let's say the auto-population is incorrect, meaning the W-2 shows $434, you just make the change. That's all you need to do. And the software will accept the change. All right, we'll go back. Here is a box for unreported tips. You may see that from time to time. And the takeaway is if someone is receiving tips, step number 1, they've got to report tip income, whether it's $1 or $50,000, and they have to pay FICA on that Social Security. We have nothing for box 12 and 13. That's typically your 401k or some type of tax deferred savings program. Like when I was working for the IRS, I had a section 414, and so I had that box. A lot of times you're going to see taxpayers who will have a retirement plan. If that's the case, we check on that. Box 14. California SDI, not everybody, but a lot of people pay SDI. So what that means is the employer will withhold these premiums and then remit these premiums to the state of California. And then if you're eligible and qualify when you're disabled, then you'll get a California disability check, which is a non-taxable event, both federal and state. Down to California, typically what will happen is of course, you have to populate the state ID number, the employer identification number, which is going to be different than the federal. Typically, your state wages are going to be the same as your federal. I think I mentioned before, years ago, I was working and living in Cuba, and I had to pay federal income tax, and my state wages in box 16 was 0. But again, typically it's going to be the same. State income tax withheld, that's going to be monies withheld by the employer, remitted to the state of California. And then, of course, your state income tax will be reflected on your state return, again, withholding. 18, 19, and 20, we don't do this in California VITA because there's no jurisdiction in California that has individual income tax. And so we don't play with 18, 19, or 20. Okay, we're going to hit continue.
There's a 0 on one of those boxes. Do we enter a 0? Like if there's a blank box on, say, Social Security withheld, we don't see it on the W-2. Do we leave it blank on the tax slayer, or do we actually enter a 0?
I'd probably leave it blank, but if you put a 0, chances are the software will not display the 0 when you're ready to go. And then if you've garbled the entry, like I say, you can go ahead and delete. If you need to make revisions, you can hit the blue pencil. Okay, so that's wages for our taxpayer. And then we're going to go to the tab, and we're going to go to child care credit. Here we go. And this is the child care credit, which is a non-refundable credit. And let's see here. Okay, so none of these entries are here. So what we'll do is we'll make some entries. We'll follow the prompts. So we have an EIN, and the EIN for her toddler time is 33654 3211. And that's toddler time. And we've got an address here. And a lot of times what will happen is your taxpayer will come into the VITA site with a receipt from the daycare provider. And that will be your qualifying expenses. Okay, we've got that entered. And we don't attend to Hawaii returns, so you can leave that alone. Your provider information. Let's see, we've got a phone number of 2222. Okay, and then it says we're caring for Maria, so we'll indicate that, Maria. And here the amount paid, and the amount paid for Maria was $2,500. And if I've done that correctly, then I think we're all set there. And so what we'll do, we'll hit continue. And then we'll answer these questions. So the first question, let me make it bigger so you can see it. It says, are any of your benefits from your employer that are not reported on your W-2? And the answer is no. Next question is, were you or your spouse unable to work due to being disabled or a full-time student? No. Did you pay any expenses for 2022 in 2023? And the answer is no. I had this issue last night when I was working on this. Let's see if I can get past the screen.
If their childcare December payment was paid on January 1st, we'd have to say yes on that.
When you say January 1st of 2023,
yeah,
yeah, if you paid your expenses for 2022 in 2023, you would say yes.
okay.
All right, let's see if I can get past this. If I can't, I can't. Okay, let's go to our education credit summary. Open this up for our taxpayer. If you went to Saddleback University, this is that 1098-T that we talked about. This will be the document that'll be issued to the taxpayer and by the school. So in this case, she got a 1098-T. And typically the 1098-T is going to show the tuition that was billed to the taxpayer and then any scholarships that the taxpayer received. It also asks about the previous year. In this case, and you'll ask that question. The answer is no, she did not receive that. And then we're going to go to our information for our school. Enter the administrative data for the address, and we indicate for California. And in this case, we've got the employer identification number, and that corresponds to the EIN for Saddleback University. And then, as I mentioned before, with the 1098-T, it's not going to show you all the information. So, for example, and I recognize every situation is different. For example, I teach at a school one semester, all of the 13 or 14,000 students, both part-time and full-time, paid $0 for their textbook. There was a multi-million-dollar grant that was given to the college. Every student was notified, your textbooks are free. They don't cost you anything this semester. But typically what happens when you go to college, you're purchasing or you're renting textbooks. So in this case, she pays tuition of $1,000. And of course, that's to improve your skills or acquire skills. And I would make an argument that if you go to college and you're taking this lifetime learning credit and you're taking a class, whether it's art history or chemical engineering, and let's say you are a tax person, you're acquiring new skills. And so anyway, tuition paid of $1,000 out of pocket, and there's no information regarding grants. There are many types of grants. There are private grants, there are government grants, state grants, but no information regarding the fact pattern and no other qualified expenses. But what I do at my VITA site is I make sure that the preparers ask the questions regarding textbooks. And typically there's an expense for textbooks. And sometimes, in fact, a lot of times, these students will show me on their electronic device that they've paid textbooks of so many dollars. And so that'll be included in other qualified expenses, also known as qualified education expenses. And so again, you want to ask about your tuition, your enrollment fees, and textbooks and supplies too.
Jerry, what if the educational institution requires them to purchase a laptop for the class?
Yeah, then that's called a qualified education expense. Now, this is important. If you have a laptop computer, and I think just about everybody I know from age 3 to 99 has a laptop computer. If you have a laptop computer and you only have one computer, what that means is you've got some personal use. And so now you have to get in that discussion. Do you want to do an allocation? I'll do the allocation between business use, i.e. school use, and personal use. And everybody has a personal life. Even if you're the president of the United States, you got a personal life. And so I've had discussion time and time again with people, and they tell me, Jerry, I don't have a personal life. And I look at them and said, yes, you do, just like I do. And so if you have one computer and one computer only, there has to be an allocation between business and personal. You got to do it. And if you don't do it, you ever go to an examination, the IRS auditor will.
Gary, can you expense, let's forget the personal, non-personal, but if it's just for school, can you expense the entire thing, or do you have to amortize it or depreciate it?
So yeah, that gets into another argument. When you purchase a computer, computer is, I mean, we don't do depreciation in VITA. Let's say you're using the entire computer 100% for school, then you can make an argument that I think I've done this before. Again, we don't do depreciation. I think I took a 3-year life, but typically you can utilize that computer as an expense. But again, you want to stay within the publication 4012.
We would let our taxpayers do that, right? If we're saying they bought a computer, it's just for school, I want to expense the whole thing, we would say, okay.
I do. I do. Yeah, I do.
Okay.
And the reason I do is because the school made them buy the computer. It's part of their education expenses, and that's part of qualifying expenses. So, yeah.
And Jerry, just
Jerry,
ahead.
How do you allocate it?
How do you allocate it?
I
I'll
mean,
give you an
if
example.
You're using half the time, you put in half the amount.
Yeah.
That's
So
it.
let's say you go through a quick calculation. You've got a computer. You only have one computer. You use it 70% of the time for your school, 30% of the time for personal, and your computer costs you $1,000. Then your allocation is $700 for school, $300 for personal.
Do you use a rule of thumb with the way you split between personal and business school use, or is it based on client by client?
It's going to be based on the fact pattern. And so you have to do those probing questions. You got to ask the individual. And again, you're typically going to say, I use my computer 100% of the time. It begs the question, how many computers do you have? One and only one. Okay, then you have to do an allocation, because you use your computer for personal things. You contact family and friend, you buy stuff, you register, you do all sorts of stuff.
And Jerry, just one more interruption. I put something in the chat. I just got an email from the IRS that the Lincoln Learn certification site is going to be offline until December 11th to fix all the problems.
Okay. Yeah, and unfortunately that does happen from time to time, but not all is lost because you can still study your 4012. You can still bone up on certain topics. And I'll share, this is no secret. Usually I certify in early January when all the problems have been fixed by the guys and gals at the contractor and the IRS.
You could do part of the test, the part that doesn't require the software. You know,
Oh, sure. You get that form 6744 and you look up your answers. Yeah, you can.
The practice lab still works, so you can use the 6744 and pretty much do everything and just wait for the
Oh,
certification.
oh, that's good. I didn't know that. I didn't know that the practice lab was up.
Yeah,
So
the
that's good.
practice lab's up. It's the certification that's down.
And the practice lab is accurate. They're not cheating. They're not.
Yeah, the practice lab is up for now, so hopefully it'll stay up. But yeah, either way, you can get some or all of it done well before the Christmas holiday.
One more question on the educational expenses, Jerry, from the chat. For college online classes, can you deduct a % of your price for your internet?
Yeah, I think the short answer for that is I think it's section 262A, but the bottom line is you can't deduct your internet. If you like, for example, I have one internet service provider in my house and I use it for everything. My tax practice, I use it to teach, I use it for personal reasons. And so there's no allocation with your internet provider. If you have a second internet provider that you use solely for your college, then that is something as far as your internet expenses if you're doing online. Most people don't have that. Most people have one internet service provider. And I think the argument would be that's a personal and family living expense. Okay, anything else, Sean?
No, that's it for now.
Okay, so then when I hit this and I saw this, did this a couple times, this is the American Opportunity Tax Credit eligibility. I already know that my taxpayer here, Jean, she attends school less than one half of the time. And so that means she's not entitled to the American Opportunity Tax Credit. So I'm going to hit cancel. But before we do, you can see that the American Opportunity Tax Credit asks about those 4 prior years. This is that HOPE credit. This is a legacy credit that existed a few years ago. So if you have someone who took the HOPE credit, 12, 13 years ago, then they dropped out of college and then they went back to college, what that means is they've used up one of their years because they're eligible for 4 years as far as the credit. And so again, that HOPE doesn't appear in any information that we see. I think it appears in the publication 970 though. And then here's where it talks about halftime. And again, the college, the university determines whether or not you're attending halftime. And this is that 4-year rule. And this is that felony drug conviction. I don't know the congressional intent. I think they want people to be clean. But the bottom line is you're not going to get the American Opportunity Credit if you've got a felony drug conviction, whether it's state or federal. And I would imagine that if you go to an examination, the IRS has some type of ability to reach out to the Department of Justice to determine if you've got a conviction. Okay, we're going to hit cancel. And then we're going to get past this. Okay. And then let's go ahead and put in that jury duty. And so we go to our income, go to our income page, and we're going to go all the way down to the bottom where it says other income. And you're going to use this tab a lot because in the VITA program, for some reason, a lot of our clients are gamblers. And some of our clients have cancellation of debt through a credit card. And a lot of times that's going to be a taxable event. So we go to other income not reported. And there's a laundry list here. And in the laundry list, this is step number 1. You're reporting jury duty pay that you have received from the court after your service. And you can see the other items. Sometimes you'd have to go to other income. Like, for example, I think a couple times I had some VITA clients, they found some type of item, jewelry, coins, they had it appraised, and then they retained it. Well, that's other income, found property. Okay, so we'll go to jury duty. And this is the amount she received, a total of $90. And it's not earned income based on that IRS document we looked at earlier. So you hit here. So that's step number one. If you have other income items, you list it up here. Hit continue. And then now we're going to go to what is called adjustments to income. So go over here to deductions. Don't know why that's recessed, but it is. And then here are your adjustments to income. And there's a whole bunch of ones you're going to see in the VITA program. We'll point those out. And so your educator expenses, this is going to be for your teachers K through 12. If they have unreimbursed expenses, and there's a limit to that. And if you have a married couple, they're both educators, then they can both get the educator expense. You might have individuals who have withdrawn money from a certificate of deposit, and these are becoming more popular now. And so what that means is you sign a contract with a bank, and you decide, like, I'll use me as an example. When I was young and not very mature, I would cash out my certificates of deposit. I would be penalized a certain amount of interest, and I would take my certificate of deposit and go to Vegas and gamble. Don't recommend that, but anyway, that's what I did. But this is something that may crop up. You might have alimony paid. I see more and more of this in the VITA program. The rules were different. If you have a divorce before January 1st, that means alimony paid. You can take what is called an adjustment to income. Those new divorces, this doesn't exist anymore. And then you have what are called traditional individual retirement arrangement contributions. And in some cases, and this is a great way for low and moderate income taxpayers, not only to take a tax deduction, but also save for retirement.
Minimum threshold for an IRA contribution is income level. The maximum level is 68,000.
Oh yeah, you have limitations, correct?
If they're earning more than 68,000 to make a deductible contribution to an IRA, they're outside of our scope.
That's correct. And generally, our VITA program, you're looking at about $64,000 or income or less. Student loan interest, you're going to see this a lot because just about everybody I know under age 30 years of age has gone to college. They all have student loans. And so what happens is, and of course, there's a phase out here, there's a limit, but a lot of our VITA clients are going to be issued that the IRS form 1098E is an echo, and they may be able to take a student loan interest deduction. Okay, other adjustments, let's go there. And you can see there's a laundry list, and most of these we will not work with. But you can see jury duty pay, and this is our second step. We've already reported the income, and now we're going to take an adjustment because Jean has taken her check and given it to her employer as the employer has required. And so if you do the math, $90 of income, $90 adjustment, the net effect is zero. And that's how you do that. Okay, so we're going to go over here to the left-hand side and see if we've addressed all of our concerns. Let me go back into our wage statement and let me take a look and see if we've entered all the data that we need to enter. And again, this is her W-2 for Piggly Wiggle. Okay, I'm looking at my fact pattern, and she has insurance that's paid by the employer. And so let's go to the right box there. Okay, and that's not the right box, so hold on a second. Okay, you can see here that box 12 and 13 in the software shows you a number of codes. And you can see these codes in the publication 4012. typically what you're going to be working with are two codes. B, which stands for deferred compensation, like a 403B, a 457, a 401K, a 414, or you have Delta Delta, which is in health insurance paid by the employer on behalf of the employee. So we're going to do that. And per our fact pattern, she had $4,600 paid by the employer. Okay, so that's that. If you had another code on the same return, again, this will be reflected in the W-2. We key it as we see it. And those other codes, I don't have those memorized. What you can do, you can jump into the 4012 if you have one of these codes on your W-2. Okay, so we now are done with our W-2. We're going to hit continue. And hit continue. All right, any questions or comments thus far?
I'll just say that if they do have those codes on their W-2, just look on the back of the W-2. It lists all the codes.
Sure, you can look in the back of the W-2. If you want to get a full description, you can go there. You can go to the 4012. Yeah, you can do that. Okay, health insurance. Now today we are not going to go through the covered California, but next week we will go through covered California. And if you're not familiar with the covered California, it's simply the California equivalent to the federal exchange. And if you remember, 2010, Congress passed, the president signed the Affordable Care Act, which was voluminous, well over 1,000 pages. It had many different provisions. And of course, one of the provisions that set up those federal exchanges where people could purchase health insurance, and health insurance was subsidized by the taxpayers. And so California decided they were going to set up their own system called Covered California. Again, we'll address that next week. But what you do want to remember, if someone's in Covered California, then they're going to have to show up at the VITA site with that IRS form 1095A as an alpha, which shows the amount of the premium they paid and the amount of the subsidy that they received from the taxpayers. And then we can prepare the return. If they don't have the 1095A, then they've got to obtain that, and then we can help them out. So in this case, she has insurance through her employer. So we'll put no, she's not in the Affordable Care Act plan. And then, of course, California is not available, so we'll bypass that. And then, Sean, can you see the Form 1040 displayed?
Oh, yeah, we see that.
Okay, so let's go through this. We got a few minutes, and let's point out a few things. And so what we do at the VITA program, of course, we will prepare the return. Typically, it'll be electronically filed. And then as a courtesy, we give a hard copy of both federal and state to the taxpayer for their records. And so you can see at the very top, that's the administrative data. In here, she did not elect that presidential election campaign, so there's no check mark there. Here's her filing status, head of household. Digital assets, she doesn't have any, she didn't buy any, she didn't sell any. If you sell, we can't help you in VITA. Let's see here, dependents. Maria is a dependent. You can see that child tax credit has automatically been checked, and she's 4 years of age. This is going to be a little bit different. If you haven't looked at the 2023 return, there are more lines that have been added. So here we have her wages of $30K. And then we have our $90 of jury duty pay. And then her total income should show $30,090, but it doesn't. So again, that's something they're going to work on with the programmers. We got the adjustment to income. That's going to be that jury duty pay adjustment. And again, only if you remit your check to your employer. AGI is $30,000 because $90 minus $90 is zero. And then we have the standard deduction. In the VITA program, we have the general rule. It's either the standard deduction or itemized deduction. If you're a tax professional and you know that if a taxpayer wants to take the lower of, they can, but in VITA will take the higher of. And if you're filing a married filing separate return that we don't do in VITA, then there are rules pertaining to that. But anyway, we've got the the standard deduction. And you can see right here, the standard deduction over on the left-hand side, this is going to be for most taxpayers, which means they're under 65 or they're not meeting the tax definition of blindness. And I think I told the story a 3 weeks ago. I had a taxpayer, VITA client, who was blind, completely blind, and I was doing a Zoom session with her, and she was answering all the questions, showing me documents, and finally she says, "Jerry, you don't recognize that I'm blind?" I'm thinking, "No, I don't." So I asked her a few questions. She goes, "I can't see at all." I said, "I understand that." She said, and I said, "Okay, then what happens is we're going to indicate that in the software. You get an additional amount on your standard deduction." Okay, so we have that. We have the standard deduction, and then here we have the taxable income. So what happens is the software then will look at taxable income and filing status, and then from that, the software is going to indicate the amount of individual income tax that needs to be paid by the taxpayer. And so you can see this, that equates to 10%, and that is the $923. We have the child tax credit. This is the non-refundable portion. And then we have the child independent care credit, which is non-refundable. And you can see right here, these non-refundable credits gobble up the tax or dollar for dollar reduction of the tax. And so a lot of times you're going to see a total tax of 0, and it simply means that they either didn't have any tax in the first place, or their non-refundable credits offset the tax. And then you can see the tax withheld. Typically, you're going to see that on the vast majority of W-2s. And here you have the earned income tax credit, which for her is substantial, and that additional child tax credit, which is fairly substantial. So she owes 0 individual income tax. Her refundable credits are going to, and her payments are a total of $5,242, and this is the amount of her refund. And when we go through in a later session, we actually prepare her for a refund. Most taxpayers are going to say, yes, go ahead and deposit those refunds in my account. So we ask them for routing and account number, and then of course the type of account. And then that way they get their check usually deposited in anywhere from about 5 to 7 business days. And of course, it doesn't end up in their mailbox, which means no one's going to take their refund. But typically that's what you see. If individuals owe money, then a lot of times they can have direct debit. Same thing, we collect their bank information. Okay. And then down here, when you do the VITA returns, you'll have VITA down here because we don't have paid preparers. You don't accept any payment for a VITA return. Then we're going to go to page 3. And page 3 has a Schedule 1. Page 1 of the Schedule 1 is additional income. Page 2 are adjustments to income. And so you can see there's a laundry list. A lot of times we'll have the Schedule C as in Charlie. You'll have that net income populated here. You might have taxpayers that have unemployment compensation, which is fully taxable by the federal government, not taxed by the state of California. Then you might have some gambling winnings, and that would be reported here on line 8B as in Bravo. And then sometimes, unfortunately, taxpayers say, hey, I received this 1099-C as in Charlie. I had cancellation of debt because they either were unwilling or unable to pay, let's say, their credit card. And for tax purposes, that's going to be a taxable event. The only time cancellation of debt is not taxed is when they have a discharge in U.S. bankruptcy court, or they were considered insolvent before the discharge of indebtedness. There's the jury duty, which is listed on line 8G, which is incorrect. So again, this is a work in progress. That should be reflected on line H hotel. for that jury duty pay, which is additional income. And then we go to our next page, which is the adjustments to income for Schedule 1. And we should have that jury duty pay amount that we put in because she remitted her check to the employer. And then on this page, you do have in the VITA program a lot of educator expenses, again, K through 12. We don't do this at St. Killian's, but if you're from Coastline College, we will have reservists, military reservists who get an adjustment to income from time to time. And then this is the penalty on early withdrawal. That's an adjustment to income. You see that? That's that student loan interest deduction that we talked about. You see that a lot in the VITA program. All right, we're going to go to our next page, which is Schedule 2. Just a couple things. You will see this from time to time in VITA. And when it pops up, you're thinking, what's that? And so when you have someone in covered California, they're going to bring that form 1095A as an alpha, and you're going to enter that data into the software. And sometimes the taxpayer received too much of a subsidy from the taxpayers. And probably the best example I can think of, one time I had a VITA client who came in and her excess advance premium tax credit was over $4,000. And she goes, what's this? I said, something happened in your life. Either you married, got divorced, a kid moved out, you had a baby, or your income went up substantially. She goes, yeah, that's what happened. She said, I used to make about $25,000 a year, and now I make a lot more than that. And she did not go into covered California to make those changes. And that's one of the cautionary tales. If you're a covered California recipient and things change in your life, go back into covered California and change what needs to be changed so you don't receive subsidies that you're not entitled to. So again, this excess advance premium tax credit, that is going to be repaid because you received too much of a subsidy. Other taxes, typically in the VITA program, your other taxes may be self-employment taxes. If you have a side hustle, you're a wage earner and you got a Schedule C. Other things we see from time to time, we do see the uncollected Social Security. That's for the individuals who haven't reported their tips to their employer. Okay, so that's that. Let's go to our next page, which is page 2 of the Schedule 2. And these are other taxes. And typically, you don't see that in the VITA program. Typically, you don't. But if you're a practitioner, you'll see some of these things from time to time. Go to page 7. These are additional credits and payments. You're going to see this schedule all the time because in the VITA program, we have individuals who have that child and dependent care expense credit. We have a lot of individuals who receive the education credits. And for some reason, that's not generating a work in progress in the software. And here's another one we see. And I want to thank one of the volunteers. In fact, I'll name her by name. This is a good thing. I think it was Evelyn, if I remember correctly. With the retirement savings contribution credit, when you are low and moderate income and you are saving for retirement, it could be a 401k, it could be a Roth IRA. Once you enter that data into the software, you may be eligible for that credit, which is a good thing. So again, you're going to see this form from time to time in the VITA program. Other things, the credit for elderly and disabled, I think I've seen this maybe 3 or 4 times in the last 35 years. So it does exist, but typically you're not going to see that in the VITA program. So again, these are non-refundable credits, which are defined as the dollar for dollar reduction of the tax. And then we're going to go to page 2, and I want to point out item number 9 or line item number 9. This is a net premium tax credit. And what that means is when someone's in covered California and they receive too little of a subsidy, then this will be generated based on the entries that you make in the software. And this is a good thing. This is a good thing. So you may see that from time to time. And then the other items, you're probably not going to see that in the VITA program. All right, Sean, I'm going to go back to page 1 and see if I can answer any questions that anyone may have. We've got 12:55, so we're about ready to wrap up.
I had a question on the data entry side.
Okay.
It was it just came to mind when you were looking at the alimony. If we forget the difference between the December 31st of 2018 and the January of 19 alimony being deductible or non-deductible, is there like a wizard or something that'll be like, hey, you know, do we get the court decree of the divorce or the separation of maintenance?
I don't recall a wizard for that, but what will happen is that'll be an issue or an item that will be reviewed because all of the returns are reviewed. And your quality reviewers typically are experienced VITA volunteers certified at a minimum at the advanced level. And so that will be addressed before it goes out the door.
Okay.
All right, Sean, anything else from the chat?
I do not see anything else.
I was gonna say, Jerry, that you enter the date of which the divorce occurred. It's on the intake sheet, so that should be captured as part of the interview process.
It is. And then what happens because people are people, some people forget their full legal name, they forget their social security number, and then they forget when they got divorced. So yeah, you got to ask the probing questions. Now, if they have the divorce decree in writing in front of you, then that's probably easy breezy. You can get that. But yeah, you're going to see a lot of unusual things invited, and you think, hey, people have that. They should have that memorized. I've even asked people, how many kids do you have? And they would look up at the ceiling and say, well, hold on, let me count. I'm not sure. So yeah, you see a lot of different things. All right, Sean, I'm going to turn it back to you then.
All right. Well, we are going to stop the recording now and just remind everybody that we'll be back next Saturday, same time, same bat station for our 4th recording session. And then December 16th will be the last one for this federal tax. We will also be doing a franchise tax board training session on the first Saturday in January. So I think that's January 6th. So for people who are interested in that, we'll sign you up. Okay. Thanks a lot, Jerry. Thanks everybody for participating. We'll have this posted